Alright, so welcome to the complete trading course for 2026 and beyond. This course will be over 6 hours long. And I expect that around 90% of people that clicked on this video won't even make it past the 20-minute mark. They will get bored, click off, and go look for another video, a 10-minute video that promises that they will get rich, tomorrow. Why do I say that 90% of people will click off the video before the 20-minute mark? Well, that is because 90% of traders also fail and lose their money. If you don't have the focus and discipline to really sit down and go through a 6-hour, free course on YouTube, you do not stand a chance becoming consistently profitable in real markets and when real money is on the line. Today I challenge you to be in the top 10% that will actually watch this course. This video is built on my 4 best video courses here on YouTube. And I have put them all together in a massive guide so you can learn trading in the correct order step by step from being a beginner to an advanced trader. But yeah, this course will be pure trading education, so if you expect, get rich quick schemes or rented supercars and all that bullshit, you are in the wrong place. But if you really want to learn trading, you are in the right place. And yeah, this right here is the game plan for today's course. So part 1 or section 1 of the course will be all about trading fundamentals. So in this part, we will talk about, things like what trading is, how trading works, how traders make money, and so on and so on. This part is super important if you want to get the most out of part 2 and eventually part 3. Learning the foundations is something a profitable trader can't do without. So this part is really to get you guys started with all the trading basics you need in order to move on to the next part, which is the 2 core pillars of trading. So part 2 will be about the pillars of trading, which is, first of all, price action is pillar 1 and market structure is pillar 2. If you can only learn 2 things in trading, I recommend to learn price action and market structure. And you will hear this throughout the course that I always, try to hammer in that you need to use price action and market structure. So as I said, we will look at the 2 pillars of technical analysis, and price action is basically the study of the live price movements. So when we look at price action, we're looking at, how is the price moving right now? And while market structure is the study of historical price. So when we look back and take a look at how the price have moved in the past, we're looking at market structure. So when we combine price action and market structure, we combine, looking at live movements with studying the past, right? This is a very important mindset to have throughout the course. Last but definitely not least, in part 3, we will move on to something called order flow. This right here is a more advanced concept and will basically be your secret weapon, because order flow is when we, instead of just looking at candlesticks, right, we will start to look at inside of the candlesticks. We will look deeper and take a look at what is actually happening inside the candles, what is creating the candles. But as I said, guys, in order to have a chance to understand part 3, you need to watch part 2. And in order to get the most out of part 2, you need to watch part 1. So as you can see, this course is really built in a step-by-step manner. And yeah, because this course is more than 6 hours long, I actually recommend to not watch this full course in one go. What I do recommend is that you treat this video as a real course. So I highly recommend that you already, bookmark this course, add it to a watch later playlist, or save the link somewhere with easy access. Basically do anything so you can easily come back to this course, and then commit to spend maybe 45 minutes to 1 hour a day, or at least 1 hour to 45 minutes, and then take a break. What I also highly recommend is that you actually take notes, and you can do this on your computer. But for me personally, I think it's something special about taking, physical notes. Because I feel like when you take physical notes, there's something that makes me, at least for me, I remember things more easy when I write things down on paper. So I do recommend, if you have a notebook, to grab a notebook. Another important thing to mention is that I will have video chapters and timestamps for this video. And make sure to really use them. Use them to maybe skip around if you need. Use them to rewatch and rewind the most important parts. And as I said, take notes, and also make sure to open up TradingView. As you can see right now, I am on TradingView, and if you have two screens, I recommend to have, maybe this video on the main screen and TradingView on the second screen, so you can start to practice concepts in real time while you are watching the video. And last but not least, trading takes time. You are not going to get rich tomorrow. But if you have the discipline to watch this full course, you will understand markets better than 99% of traders. So go grab a coffee, lock in, and let's get to work. Welcome to part 1 of the course. Now let's talk about what trading really is. What is actually trading? Well, if we strip down trading to the fundamentals, so what is trading in the simple core terms, then we can actually see trading as a decision-making skill. When it comes to trading, we basically always have a decision to make. We either buy something or we sell something. And can you guess what the third option is here? This is probably the most important option. That is to do nothing. I see so many beginner traders losing because they can't sit still. They can't, watch a chart for hours and don't do anything. But as a trader, this is a very important skill, because you need to be able to wait and wait and wait until your setup and your trading strategy actually appears, because that is the moment where you will actually make money. So most of the time as a trader, you actually do nothing. And with doing nothing, I don't mean that you literally don't do nothing. You spend a lot of times just scanning charts for the best setups. So here, I like to think about trading as you are managing risk and not predicting the future. So I like to think about the game of poker, because when you are playing poker, you might have a good hand, you might have a bad hand, but at the end of the day, you might have the best hand possible, you might have double aces, and you can still lose the round. And trading here is the same. What we as traders can do by making better trading strategies and learning more about trader is that we can more and more often get better and better hands, but we can never predict with 100% certain that something will happen. And this is something I want you to write down already right now. If you have been, hearing, maybe a trader say that they 100% know that something will happen, then that is bullshit. No one knows that something will happen with 100% certainties. What we as traders do is that we want to increase the odds that we are being right. And that is all we can do as traders. But over, large amount of time, let's say we only have, 60% chance of being right, then we will, make money. Or actually, it's a little bit more complicated, but we will talk about that later on in the course. So don't worry. As for now, you can think about it like this. Another thing you need to consider is that losses are just part of the business. I like to also think about trading as a business. No business will have no costs at all. You can think about losses as a sort of investment and as just a natural part of trading. You will, if you're not willing to never lose, trading is not for you. And another very important thing here is that one trade means nothing and the process means everything. Once again, you can think about poker. For example, the best poker player in the world might lose to the worst poker player in the world just by pure luck. But if they play 1,000 games, the best player in the world will crush the noob. It will crush the beginner. And you need to think about trading the same way. So here it's very important that if you want to be a successful trader, consistency is much more important than intensity. So the trader who studies, let's say, a little bit every day for a year will beat the trader that, goes all in for just like a few weeks. I think consistency is key. But alright then, so now let's take a look at the trader framework. And this is a step-by-step process you need to follow every single trade, especially when you are a beginner. So here, every trade follows the same structure. And there are 3 steps you need to follow. And you can look at the image right here. And the step-by-step process is super simple. First of all, we need to find a market setup. And you might wonder, how do we find a market setup? Don't worry, we will talk about exactly that later on in this video. But in very simple terms, finding a market setup is that you look out for certain conditions. And if you check all of these boxes, you are now ready to go to the next step. And the next step is to plan your trade. And here you need to plan 3 things. The first thing you need to plan is your entry. Your entry is, of course, when to enter, or where on the chart to enter. What needs to happen for us to actually buy a stock or buy a cryptocurrency. The next thing we really need to do, and this is one of the most important principles of risk management, is that we need to set a stop loss, or for short stop. So a stop loss is basically a level that if the price falls below this level, we automatically sell. And this is so important, and we will talk about that more soon. But for now, all you need to do is that we need to have an entry, stop loss, but we also need to have a target. You can think about a target as the opposite of a stop loss. That is a level that, when the price goes up to that level, we will automatically, lock in profit. And here, if any of these steps are missing, then it's not a trade. Then you are actually gambling. You're just guessing that the market will go in a certain direction. You don't really have a plan. At least for beginners, it's very good to think about it like this. We need an entry, stop, and target. For more advanced traders, there are some more advanced strategies as well, but I think that everyone should begin with this mindset: entry, stop, target. But now, the process is not done here, because what we then need to do is that we need to execute and also review the decision. So we have, for example, something called trade management. That is, what do we do while we are in the trade? Another important part of execution is something called trading psychology. If you have been trading a bit, you're probably familiar with this. And that is that, when, let's say that the market starts going against you a lot, the market maybe drops quickly, then you can start feel, lots of fear. You are, it's only natural to be fearful about losing money. And that can in turn make you think that, maybe I should, remove my stop loss because I really think the market will go back. So the emotions can basically make you, go away from your plan. And that is a very slippery slope. That is a dangerous thing. So you really need to practice your trading psychology. And also for the upside, trading psychology can lead to greed. Maybe you win, multiple times in a row, and you think that you have beaten the game of trading, and you start taking more and more risk because you get more and more greedy. That can also be a fast road to, basically losing everything. So very important trading psychology, very important to manage your trade. And also another important thing is that you want to review your trade. So after a trade, it doesn't matter if you won or lost, you want to take a look at, did I actually follow my plan? And if you didn't follow your plan, what happened that made you didn't follow your plan? It's very good to write that down in maybe a trading journal. But alright guys, so now in order to trade, there are a few tools you really need. But here, especially for beginners, I really recommend to keep it simple, because there are only a few things you need. First of all, you need a charting platform, or in other words, you need a platform where you do all your analysis and where you plan your trades and where you basically do everything you need in order to make the decision of whether you should take a trade or not. Should you buy this or should you buy that? And for charting platforms, I highly recommend TradingView. And let's take a quick look inside. Alright, so now we are inside TradingView here, and TradingView is the platform I use for, all my technical analysis. All analysis I need to do in order to decide whether I should buy or sell something is done here in TradingView. And nowadays, TradingView can be used for, other things as well. You can use TradingView to find news about what you're trading. You can use TradingView to do, fundamental analysis. So you can analyze, for example, stocks, how are different businesses performing, and so on and so on. But TradingView is mostly a platform for analyzing charts. And this is also the platform I will use throughout this whole course. So what I actually recommend right now is to, sign up for TradingView. And maybe if you have two screens, you can have TradingView on one screen and my video on the other screen, so you can follow along during this course. And before you sign up, I have to mention that I do have a special link to TradingView, and I highly recommend to use that one. Because if you use that link, you can first of all, if you want to, you can try out TradingView Premium for free for 30 days. So you will not have any ads, and you can use, for example, multiple indicators and use all the features inside TradingView. But also, if you use that link and then maybe later on decide that you want to upgrade, maybe you start with the free version and then maybe later on want to as you get better at trading, you maybe want to upgrade, then you will get a $15 bonus. So I will make sure to leave that link in both the description and the pinned comment. So I actually right away pause the video and sign up to TradingView, and I will see you soon. But right, so now when you have a charting platform where you do your analysis, the next thing you need is a platform where you actually buy and sell, where you actually take your trades. In other words, you need a trading platform or a broker. And here, this will depend quite a lot on where you are from and what you are trading. So for example, are you trading, crypto? Maybe you are focused on stocks. Maybe you are trading Forex. You need to decide what to trade, because the best broker will depend on what you are trading. And here for beginners, I would probably, recommend stocks to begin with, or you can also trade crypto. But if you trade crypto, I highly recommend to, start with the larger cryptocurrencies. I would actually probably start with Bitcoin, BTC. And with stocks, I also would recommend, starting off with the bigger stocks, because the bigger cryptocurrencies and stocks tend to move, not as wild. So for example, a large stock might move, something like this, while, a small stock or small cryptocurrency might move, very more like this. We call this move here to the right, we call high volatility, and we call this move to the left low volatility. But if you want some recommendations, if you're trading crypto, I can highly recommend Bybit. So Bybit is a crypto exchange. I think it's like the 4th largest exchange or something like that. I think it has a very beginner-friendly interface, and it has many different cryptocurrencies. I also for Bybit have a special link, and you can use that link. It will be in the description and the pinned comment. And the more you trade on Bybit, the more free bonuses you will get, and you can get up to a total of $30,000. But I can already warn you guys that most will not even get close to 30,000, because you will need only if you are rich and trade with lots of money, you will get that. But I think that most people will get like $100 for free. So make sure to check that link out if you want to trade crypto. If you want to trade stocks, I think this one depends a lot on the country you are from. I'm from Sweden, so I mainly use a broker called Avanza. But as I said, this one is only available in Sweden, and I highly recommend that you do your research. Nowadays we have very good, I would actually recommend using a LLM like ChatGPT, Gemini, or Claude to basically do some research on what broker that fits the best for you. And the same thing is true here with Forex. But here, a question I get asked a lot is, but what about TradingView? Can I trade inside TradingView? And the answer to this is actually yes, but only for certain brokers. So to check if your broker is available for trading directly in TradingView, what you need to do here is that you need to go down to where it says trading panel right here. And as you can see, this window right here will pop up, and you can see that we have multiple different brokers that you can connect to TradingView. So if you're using any of these brokers like OKX, that is a common crypto one, Binance, a common crypto one, we have some Forex ones, we have some stock ones as well. We can also click show more here. For example, as you can see, Bybit that I talked about. If you use Bybit, you can connect Bybit to TradingView and trade inside TradingView. Very useful. And what you also can do, and this we will talk about later, is something known as paper trading. Paper trading is a function inside TradingView that you can use to practice with fake money. And I actually have a video about that, so I will make sure to link the video in the video card as well as the description. Add that one to a watch later playlist or bookmark that one so you can watch it after this course. So here, as I said, you also want a demo account for practice, and here I highly recommend TradingView paper trading. And what I also recommend, another tool that is useful, is some sort of trading journal. This can be, a physical. This can be, a physical book. For some reason, I really like, to write things down physically. I feel like it, helps. I don't know, helps with my memory. But you can of course also track it, in a digital way. I think that is, for most people, maybe the best way to do it. But I'm a bit old-fashioned when it comes to trading journal. But what I mean with trading journal is basically you write down, why you took your trade, how did the trade go? Did you win or lose? How much did you win or lose? And also maybe write down some comments like, for example, how was your trading psychology? Did you follow your plan? And so on and so on. But right, guys, so now the time has come to, probably the most important skill you need as a trader, and that is, of course, how to read price. Reading price is, the sort of heart of analyzing charts. And in order to be able to, look at a chart, like, for example, this, and decide, whether to buy or sell, and sort of do your whole analysis, the very first thing we need to do before we can look at a chart as a whole is that, of course, we need to zoom in, and we need to be able to understand the individual candles. And here, and this is very important, the price will always tell you a story. So when you look at, the price, you shouldn't just think about it as, numbers on a screen. Behind every candlestick, so for example, this right here is a bullish candlestick, and this right here is a bearish candlestick. Behind every candle are a battle between buyers and sellers, and there are emotions behind the candles. Some traders maybe lost a lot during a candle. Some traders are feeling euphoria because they are making a lot of money. So when we read candles, we basically want to think about it as we are reading the sort of collective psychology of the market, right? It's very fascinating. But here, the very first thing we need to do is how to read candlesticks. And in simple terms, candlesticks show us 4 things about the price. So here, let's take a look at how to read candles. First of all, we have 2 types of candles. We have the green candle, which is known as a bullish candle, and we have the red candle, which is known as a bearish candle. On some charts, the green candle will be white and the red candle will be black, but green and red is by far the most common. And a bullish candle simply means that the price went up during the candle. And a bearish candle simply means that the price went down during a candle. And you can see that we have 4 points here. We have, let me change color here. We have the open right here. this is where the price start, and we have the close here, and this is where the price was at the end of the candle. But we also have something known as a low and a high, and the low is the lowest point the price reached during that candle, and the high is the highest point the price reached during that candle. And now you might ask yourself, but okay, so I understand this, but what is the time period of a candle? And the answer here is that you can decide. So you can decide if you want every candle to maybe be 1 day, or you can choose every candle to maybe be 1 hour, or you can choose every candle to be 5 minutes. That is completely up to you, and I will soon show you guys how to do this in TradingView. But for now you understand how a green candle looks like, and the red candle is simply the opposite. Remember, the price falls during the candle, so it opens now up here, and before the candle is over, so for example before the day is over, the price is down here. The lowest spot the price reached was down here, and the highest spot the price reached was up there. But right, so now let's jump back here into TradingView. Right now, as I am speaking, I am looking on a gold chart, and I will try to use this chart as much as possible during the course, because when I create courses, I always try to use the same chart so that I can show you guys that the principles from this course can all be applied. But here we're looking at gold, and right now we're looking at, you can see it says D up here. That means that we're looking at a daily time frame. So in other words, every candlestick on this chart represents 1 day. But if we want to change the time frame, we can go up to right here. So you press right there, and now you can see that we have so many different things to choose between. We can choose that every candle is 1 day. We can choose that every candle is 1 hour, or 4 hours, or maybe 1 hour. Let's for now switch to 1 hour. Now every candlestick on this chart will be 1 hour instead. Oops, let me fix that. And now, just as a practice, let's take a look at how to read one of these candles. Let's for example look at the green candle. Remember, the green candle opens right here, so the price started right here. During the candle, the price actually reached a highest point up here. Remember, the wick is the highest point, but before the candle closed, the price fell down to this point right here. So this is basically how the price moved in on this candle alone. And if you look at maybe all of these candles together, maybe the price looked something like this. Remember, it opened right here, it went up to a highest point down here, then it went down here, then it went something like this. Not really, but I hope you get the point. So here, time frames show you basically the same story but with different details. So we can for example look at a daily time frame, but if we want more detailed information, we can zoom in to the 1 hour time frame. And if we want even more detailed information, we can zoom in even more to the 5 minute time frame to take a look at what is happening. So we can basically think about time frames as using a magnifying glass and investigate the price movements even further. And also here, in general, markets move in something known as trends or ranges. So what a trend basically is, a trend is when we have a market, going in a certain direction. The market always goes, up and down, but the trend is sort of the overall direction of the market. So this right here is, for example, an uptrend. You can see we have an uptrend right here, while a range is when we don't really have a certain direction. The market might go something like this and basically to the sideways. And don't worry, we will talk more about uptrends, downtrends, and ranges very soon. And here, and this is very key, one thing I hear so many beginners talking a lot about is trading indicators. And trading indicators can be a very useful tool. It can help your analysis, but it's very important that, as a trader, you need to really start by learning, about something called price action. Price action is basically the study of how the price moves in the very short term. So what is the price doing right now? And you also need to learn about something called market structure. These two concepts are so much more important than learning about indicators. Before you even learn about your first indicator, you need to learn about price action and market structure. And we will talk a little bit about both price action and market structure in this course. And I also have, you know, long courses where you can dive even more deep that are more advanced on the channel. I will make sure to link my price action trading course both up in the pinned comment, a video card, and the description. And I will also link my market structure trading course in the pinned comment. I mean in the video card and the description as well. So make sure to add these courses to a watch later playlist or bookmark them because you do want to watch them after this course. But for now, that is all you need to know. Alright, so now let's talk about one of the two most important foundations in trading, and that is something called market structure or market structure and trends. And this is something you basically need to learn before everything else. And the very basics here of market structure is that you need to learn about trends and you need to learn about ranges. And first of all, we have two main types of trends. We have the uptrend and we have the downtrend. And in order to have an uptrend, we need to have both higher highs and higher lows. So let me show you right here. So when the market moves, the market might move something like this, something like this, something like this, something like this. This right here is what we call a high. We usually just write an H, and this right here is what we call a low. We usually just write an L. And in order to have an uptrend, we need to continue to print both higher highs. So for example, this right here is a high, but it's higher up. So we call it a higher high. And this right here is a higher low because it's a low point, but it's higher up. And as long as this pattern continues, we have an uptrend. But it's very important to notice that we need to have both higher highs and higher lows to have an uptrend. So if we, for example, let's say we have a market that looks something like this. You can see in this kind of market, we are having, you know, one high right here, then we have a higher high, and then we have an another higher high. So some beginners might look at this and think, you know, this is an uptrend, right? Well, it's not an uptrend because we can see that the lows here are all on the same level. So this is not, you know, an uptrend. So this is very important to have in mind. We need to have both higher highs and higher lows to have an uptrend. And the same thing is of course true for the downtrend, but the opposite. In order to have a downtrend, we need to have both lower highs and lower lows. So, you know, let's say we have a market that looks something like this. This right here is a downtrend because we have we have a high, we have a lower high, we have yet another lower high right here. We have a low, we have a lower low, we have yet another lower low. But if this market stops printing, you know, either, you know, lower highs or lower lows. So let's say that this market might go something like, you know, this. You can see now it has passed the point of the lower high. At this point, we are no longer in a downtrend. But it's very important to notice here that this does not mean when we break this point right here, when we break this point, this does not mean that we automatically go into an uptrend, because we do have yet another state that you need to know about, and that is that we have sideways movement. So this is all the market conditions that are not an uptrend or a downtrend we count as a sideways market. And when most you know, especially beginners think about sideways markets, we think about a market that goes something like this. The market trades here in between two clearly defined lines. We call the bottom line here is known as support, and the upper line here is known as resistance. And we will talk about this very soon. Support and resistance, very important concept to learn. But most traders, when they think about ranges, they think about a market that looks something like this. And this is true. This right here is one type of range, but we have many other types of market as well. For example, let's say that we have a market that looks something like this. This right here is a market where we're printing, you know, we have a low, we have a high, but then we have a lower high and we have a higher low, and so on and so on. So this is neither an uptrend or a downtrend. This is actually one type of a sideways market. This is actually almost looking like a triangle, right? And this is a specific pattern we call it a symmetrical triangle, and that is what is known as a chart pattern. We will talk a little bit about that later in this video, but I also have a full course on chart patterns, so I'll make sure to link that course up in the video card as well as the description. But for now, all you need to know is that ranges does not, or sideways market doesn't have to be perfect ranges. They can also be, you know, triangles, and they can also be, you know, markets that maybe look, you know, something like this, right? Actually, in real markets, you will many times see price movements like this, because real markets are often not these kind of perfect markets that you see in textbooks. And here, a very important principle, especially for beginners, is that it's important that, you know, you should start by analyzing the trend. Because in order to, you know, take a trading decision, some trading strategies only works in uptrends. Some trading strategies only works in sideways markets, and so on and so on. So what we first need to do is to identify if we even are in an uptrend, downtrend, or sideways markets in the first place. This basically filters out the bad trades. Alright, okay, so now let's actually jump back here into TradingView. We are looking here at the daily time frame, and we are looking at gold. So every candlestick on this chart represents 1 day. And if you are still on this point in the course and you don't have TradingView yet, from now and you know, in the future, we will be using TradingView a lot. So I highly recommend to get TradingView right now. And as I said, I do have a special link that will be in the description and the pinned comment. So make sure, guys, to get TradingView. And now let's actually start to analyze this chart right here. And the first thing we can see, if we analyze this sort of recent trend right here, we can see that the price sort of started down here. It pushed up, right, to this point. Then it fell back. This right here is what is called a pullback. And this first move right here is what is called an impulse, or impulsive moves. And trends are basically built on impulsive moves and pullbacks. Impulsive moves and pullback. So, for example, right here, we have the next impulsive move. And you can see that we actually print a higher high, a slightly higher high here. Then we pull back once again. Then we have an impulsive move all the way up here, right? Then we pull back once again. We have an impulsive move that we are in right now. And we have a potential, you know, pullback coming. But remember here, as long as we are printing, you know, we have a low, we have a higher low, we have a higher low, and so on and so on. We have a high, we have a higher high, and so on and so on. As long as this pattern continues, we are in an uptrend. But when you also can notice, if we zoom out a bit more here, you can notice that this recent trend right here, this one was, you know, relatively simple to read. We had this nice impulsive move, pullback, impulsive move, pullback. But in real trends, in real markets, you will many times find much more harder markets to read. For example, this recent move right here for gold almost looks like a straight line, right? This is almost what we call a parabolic move to the upside. And these moves can actually be much harder to trade compared to these sort of perfect, or this one is not perfect, but much more clear trends. Then, if we scroll back even more, you can also see that here we have a very interesting thing. Here it almost looks like we have some sort of, you know, pattern, right? We have some sort of resistance, it looks like, and then we have some sort of upward sloping support. This is another thing you will often see in markets. This is chart patterns that I talked about earlier. But what you hopefully can clearly see is that the overall trend here is clearly to the upside, but we do have many sort of pauses in the trend. So for example, right here, and we can also actually almost look like this part right here as a pause in the trend, and so on and so on. So we as traders need to be able to read both trends, but also these pauses, because these pauses can actually be very good opportunities to, you know, find trades and as a result make money. Alright, so now the time has finally come to learn about support and resistance, and this is basically where the decisions happen, where the most important, I would say, the most important decisions on the chart happen. So another word for this is that they are key reaction zones, and this word right here, zones, is very important to have in mind when we talk about support and resistance. But in very simple terms, support is basically an area on the chart where the price stops falling, and resistance is an area on the chart where the price stops rising. So the most common way to explain support and resistance is to, you know, let's draw a line right here and a line right here, and we draw a trading range. So as you can see, the resistance here, we can write resistance here in red. Every time the price reaches this level, you can see that we get a reaction to the downside. This is where the price stops rising. And the same thing, but the opposite is true with the support. As you can see, every time the price reaches this level, the price stops falling, and we get a reaction here to the upside. But one thing I dislike with, you know, explaining it in this way is that in real markets, support and resistance will not be this sort of perfect lines. I really like to look at support and resistance more as areas or zones rather than lines. So it would be a much better, you know, demonstration here if we draw the support as an area and the resistance as an area. So this is what one thing I want to want you guys to have in mind right away here, is that I want you to look at resistance levels as areas where the price is likely to stop falling, and I want you to look at support as areas where resistance as areas where the price is likely to stop rising, and support as areas where the price is likely to stop falling. And I also want to really emphasize that a resistance level definitely doesn't mean that the price will not, you know, go above it, because in real markets, let's actually extend this resistance level right here. Let's extend it like that. In real markets, what many times will happen is that the price will break above the resistance, and many times the break of the resistance, this is what is known as a breakout, will actually be very good trading opportunities. So we as traders need to, you know, we can both trade the reaction to the support and resistance, but we can also trade the break of support and resistance. And here, and this is very important, when it comes to support and resistance, the obvious levels matter the most. A super common mistake that beginners make is that they draw way too many support and resistance levels on the chart, and that just makes the chart harder to read. The reason we're even drawing support and resistance levels in the first place is to make the chart, you know, easier to read, not harder to read. So a good rule of thumb here is that if the level is not obvious, ignore the level. It's better to, you know, most levels, especially for beginners, should be ignored. Focus on the most important levels. So now, to show you guys why the most important resistance levels matter, let's go back here to the gold chart. So we are once again in TradingView. We are once again on the gold chart on the daily time frame. So every candlestick on this chart represents one day. But what I want you to learn from this chart right here is that, you know, okay, so first of all, let's just look at this chart right here. Which level, support or resistance, looks most obvious to you? Well, For me, the answer is super clear. And I can already show you guys how I draw my support and resistance in TradingView. I use geometric shapes. If you go here to the left, you click geometric shapes, and then you use the rectangle tool. This is so we can draw, then you press on the chart right here and we can draw a zone. To capture the whole zone, to capture all of these touches, we would have to draw it something like this. So this right here is a resistance zone. And as you can see, this one is super clearly visible on the chart. We had, 1 touch, 2 touch, 3 touch, 4 touch, almost another touch right here. But then what I really want you to notice, and that we talked about earlier, is then the price finally broke above. And what happened after the price broke this level? Well, this was actually the beginning of a massive move towards the upside. And if you caught this move, you could have made lots of money. And I'm not saying the only reason that this happened was that we had such a clear resistance level. But what I do say is that it's likely, a strong reason why this rally had so much power was because we broke such an important resistance level that many traders have been paying attention to, and that has lots of emotions behind it. Think about it. Many traders probably tried to short. Short is when you bet against the direction of the market on this break, because so many times historically the price got reacted right there. So many traders thought, if I short the market right here, I can make money. But when the price broke, this means that the players that are short have to buy back the gold. And this leads to even more buying pressure. And there are lots of reasons behind why these sort of key support and resistance levels are so important. This is maybe, sorry if I'm rambling a bit right now, I'm sorry about that. But there are many reasons that makes these clear levels significant. To show this principle even more, let's look back, far back here to one of the most important, I would say one of the most important gold resistance levels of all time. Look at this zone right here. Look at this zone. For basically, let's see how long time this range lasted. It lasted from August 2020 to basically February 2024. So this was a multi-year sort of trading range for gold. And the price was super clearly reacted 1 time, 2 time, 3 time. Strong liquidity grab right here. That is a bit outside the scope of this course. But you can see that when we actually broke above this resistance, this was the beginning of this whole massive explosive move towards the upside. And I hope this shows, how important support and resistance can be if you focus on the most important support and resistance. However, if you focus on insignificant support and resistance levels and try to draw support and resistance everywhere, this is, as I said, a super common mistake for beginner. They try to draw support and resistance levels everywhere. Then that can just make the chart harder to read and lead to worse decisions and less money. Alright, so real quick, I just want to mention that I have just recently, for the first time ever, released 2 physical products. And this has been something that has taken, way longer than I thought. It has been a long process in the making, but they are finally here and I'm super excited to share. So the first product, this right here, is a sort of massive, as you can see, it's a massive mouse pad / desk mat, and it's actually kind of like a candlestick pattern / chart pattern cheat sheet. So you will find most of the important candlestick patterns, most of the important chart patterns, and you also have things like, indicators, what they do, and the formulas. You have time zones and some more information as well. And we have been working really hard to not just make this, a cheat sheet. We also, of course, want it to be visually appealing. And I don't know, I'm super happy here with the result, and I hope you guys will be as well. But the other product is, when it comes to trading, one thing that is super important is, of course, to be able to be focused. So the second product we have created here is a device to consume caffeine, and of course talking about a mug. And on this mug, it's a pretty similar print. You can see we have candlestick patterns, we have some chart patterns, time zones, and so on and so on. And I really like this mug because this is a big size. I prefer drinking from a big cup in the morning, but we also have a smaller size as well. And to find the products, the easiest way to do this is just to scroll down on any of my YouTube videos, and you can see that you can find the mouse pad and the cup here just under the video. So you just simply click on one of these, or you can just go to, as you can see right here, you can go to shop.mindmathmoney.com, press enter, and you are here at the shop. And last but not least here, just to help you guys save a few bucks and as a sort of thank you, you can go here to promo code or gift cards and enter MMM10 and then click apply. And just like that, you will have 10% off on all your orders. So yeah guys, I really hope you will enjoy the products. Let me know in the comments what you get. But now let's jump back into the course. All right, so now the time has come to take a look at order types. And order types are something, you know, every single trader needs to understand, because no, it doesn't matter if you trade, you know, crypto, stocks, or forex. Order types is what you use to actually buy or sell. So you really needed to learn about order types in order to trade efficiently. And here, when it comes to order types, we have basically three main methods to buy or sell. And the first method here is what is known as a market order. And a market order is very simple. That is when you buy or sell for the current price. So let's say that Bitcoin is right now trading at $100,000. If you use a market order, that simply means that you will either buy or sell Bitcoin right now for around $100,000. Remember, the market is, you know, moving all the time, so you might not get the exact price you are looking for. Your broker will basically find the best possible price right now and either buy or sell. So we have a buy market order, that means that you are buying for the current price, and we have a sell market order, and that means that you are selling for the current price. But here we have two more types of orders, and the first order you need to learn about is something known as a limit order. And a limit order is when you enter or exit, or in other words, buy or sell at a better price. And what do I mean here by a better price? Well, a better price will be a little bit different depending on if you want to sell or if you want to buy. So let me explain. Let's say that once again, Bitcoin is right now trading at $100,000. And let's say that you want to buy Bitcoin. If you want to buy at a better price, would you prefer to buy lower or buy higher? It can be easy to think about, you know, when you buy your morning coffee, do you prefer a, you know, $1 coffee or a $10 coffee? Well, when you buy something, you pretty much always want to buy it for lower. So this is what the buy limit is. It's when you place a buy order below the current price. So we might place the buy order at, say, you know, 90,000 US dollar. And what this means is that if Bitcoin, you know, drops down to this level of 90,000, we will automatically buy Bitcoin. And we can of course choose how much you want to buy. You definitely don't have to buy a full Bitcoin, but this is basically an order that sits at $90,000 and waits for the price to drop. But then we also of course have the sell limit, and when you want to sell something, what is a better price when it comes to selling? Well, of course you want to, you know, sell for as much as possible. So a sell limit order is always placed above the current price. So we might place a sell limit at 110,000, and this means that if the price comes up here to 110,000, we will automatically sell. And yeah, that is pretty much it for limit orders, but we have yet another super important order type. This one can be a little bit harder to understand, so make sure to really pay attention. And this is, this is the stop order. And the stop order is when we enter or exit, or in other words, buy or sell, after confirmation. Or you can actually think about this as that we enter or exit at a worse price. So A stop order is basically the opposite of a limit order, but an easier way to think about it can be to think about it as enter or exit after confirmation, because that is often how we use the order. So let's once again, to just keep it, simple, let's say that we, buy at $100,000 right here. And let's begin here with the buy stop order. So the buy stop order is placed basically at a worse price. So we need to place the buy stop above $100,000. So we might, for example, place a buy stop order at 110,000 instead. And now you might wonder, why would you want to buy for a higher price than the current price? And the answer is pretty simple. Let's say we have a scenario here where we have a resistance level, and the price might be, let's say that the price is currently maybe right here. So right here is $100,000. But maybe we have a trading strategy that if the price goes up here and breaks the resistance, then we might want to buy right here. So we might want to enter right here, right? And this level might be the 110,000 level. So this is a perfect example of when a buy stop makes sense. You wait for the price to go up in order to buy. As I said, this can be a little bit hard to, grasp in the beginning, but it's very important. The stop loss is the opposite. This is when we sell for a worse price. So it's called a sell stop, or another name for it is stop loss. And this is actually a very important order and a very common order. This is when you wait for the price to go down to a certain level and then you automatically sell. And sorry, I just realized my camera is a bit on the way. I hope it didn't bother you guys too much on the last slide. I might have, my camera might have been in the way. But here, the stop loss or sell stop is placed below the current price. So maybe we place it at 90,000 right here. And that means that when or if the price goes down to 19,000, we will automatically sell. And once again, I want to emphasize that this is a super important order type, and this is an order type that basically protects you. It's a very important risk management tool because it automatically limits losses from not going too far. It's often important to, if the price goes against your strategy, it's often a very good idea to cut your losses relatively quickly and use a stop loss. And okay, here before we jump into TradingView, I want to show you guys how you can actually place some orders inside TradingView. Before we do that, I just want to once again emphasize that orders are tools. They are not, strategies themselves, but they are basically, buying and selling tools you can use within, any trading strategy. But right, so now let's actually once again jump into TradingView here, because now I want to real quick just show you guys an example of how we can actually place buy and sell orders inside TradingView. And to do that, you want to go down here to where it says Open Trading Panel. And remember that if you use one of these brokers, for example, if you use, Bybit, as I showed you guys earlier in the video, by the way, remember the special link if you want to trade crypto. But if you use, for example, Bybit, you can use that one. But what every single trader can use is something called paper trading. So if you click right here on paper trading and then click connect, what you can basically do is that you can do a simulation of a real, trading environment. So here you can practice trading with fake money. And this is a very good way to just show you guys how to place buy and sell orders. So to place buy and sell orders in TradingView, you can either right click and go down right here where it says add order, or you can also click up here. You can see it says buy and sell. So you can, for example, click right here. And now, as you can see right here, we have the 3 different order types you just recently learned about. So, we have the market order, which is that you buy or sell for the current price. We have, of course, the limit order, which is that you place at a level that is better than the current level. And we also have the stop order. So let's, for example, say that we want to place a limit order, and now we can choose to, either sell or buy. And since we don't have any gold right now, we place a limit order. And as you can see, right now the price is at 4,596. I hope you can see it, 4,596 right there. So the buy limit order we want to place below the current price. So let's say that we place it at 4,500 right here. That means that when the price goes down to that level, we will automatically buy. And then we can choose how much here. So 10 units in this case is $900. So let's just, for simplistic sake, let's just choose 10 units, or we can use, I think the standard is 15 units. So now the price will be exactly where we set our limit. And here where it says exits, you can see that we can set our stop loss and take profit. So we can choose here to automatically, if or when the price goes down to the limit, remember that is when we actually buy our gold. But here we can trigger a stop loss so that we can, for example, set the stop loss. Remember, we want to set the stop loss below the current price. So we can set it at 4,400. And let's say that we have a target level here at 4,700. Now, if we scroll in, I hope you can see what this means. So this means that if the price goes down here to our limit, this is where we will automatically buy. And when we buy, two things will trigger. First of all, this line right here is the stop trigger. So this will be triggered right here. If the price goes down to our limit, then we will automatically place a stop order right there. And we will also place a target order up here. So we will have our target up here. So if it goes down to 4,500, we will automatically have a stop loss at 4,400, where we will automatically sell. And we will also have a target up here where we also will automatically sell. But in that case, it's a target order, which means that we will lock in some nice profit. But all right then, so now I want to take a look at what makes a real trade. What do you need to do in order to actually, have a trade in place? And here, this is pretty simple, but every trade must include these 4 points. First of all, it needs to include an entry price. So you need to know where you either go long or where you go short, right? And if you didn't know, going long, this is when you buy normally. You bet that the market will go up. So you maybe buy at 100 and you want the price to go up to maybe 120 and then you sell. But going short here, that is the opposite. This is basically when you make money from the price going down. And this is one thing that is so nice about trading, is that you can make money in both bull markets and bear markets. Or in other words, you can make money when the price goes up, but you can also make money when the price goes down. So you need to have an entry, whether you're going short or long. And what you also need to have is that you need to have a stop loss. And your stop loss will of course be different depending on where you, if you go long or short. So for example, if you go long, your stop loss will be to the downside, but if you go short, your stop loss will be to the upside. And I will soon show you guys this in TradingView. Next, we of course have a target level. You need to have a target, so you need to have a goal for when you will sell. And last but not least, you need to have a position size. So it's not enough to know, at what price to buy. You also need to know how much should you buy. So if you check all of these points, you have a trade. And here, it's very important. I emphasize this as the most important part, and that is that you always need to set a stop loss. To be honest, you should always have all of these 4 points, but the stop loss, I would say, is the most important part, because that protects you from devastating losses. But all right, so now let's once again jump back here into TradingView. As always, we are here on the daily time frame, and we're looking at gold right now, because now I want to show you guys the long position tool and short position tool in TradingView. This is a great tool you can use to plan your trades, whether you're going short or going long. And also guys, if you are still at this point in the course and don't have TradingView, as I have already mentioned, I'm sorry if I'm repeating myself, but I highly recommend it to get TradingView. I think that you know, using an interactive learning method is much better. It really makes you learn faster. So I'm sure to get TradingView, and if you as I said multiple times as well, if you want to try, you know, TradingView Premium, make sure to use the link below. But right, so now to find the long position and short position in TradingView, what you want to do is that you want to go up here to forecasting and measurement tools. And then you can see we have long position right here and short position right here. You can actually star both because these are very important. And now let's say that we think that the gold price will continue to go up. Then we of course use our long position. And how we use the long position is basically, let's just say that we imagine that we have done an analysis right here and we think that gold will go up. Then we simply press right here. So we enter at, you know, the candle close of this candle. And then you can see here that we have a target level. So we can choose here where to take our target. And we can also choose here where to place our stop loss. And when we go long, the stop loss will be to the downside, the target will be to the upside. Let's say that we have done an analysis and that we have, you know, came to the conclusion that we want to set the stop loss below here. Then, you know, a common risk to reward ratio is that the target is twice as long as the stop loss. So you can see the distance from the entry to the stop is half the size of the distance from the entry to the target. This is just a common target type, and don't worry, we'll talk about that more soon. But this is simply how you use the long position, and we will use that tool more in this video. But for now, all you need to do is where to find it and how to use it. And what you also of course need to do is how to use the short position. So the short position is when we bet that the market will go down. So you can see that now the target will be to the downside instead. So let's say that we have, you know, maybe we have the target just before this low right here, because we expect maybe a bounce there, I don't know. But here you can see that when we short, the stop loss will actually be to the upside. And this creates something very, very interesting. And that is that if the market goes up here and, you know, goes to our stop loss, that actually means that we will now have, it's called buying back. We need to buy back, in this case, gold, and this can actually lead to more buying pressure. And that is a very interesting aspect. It's a little bit outside the scope of this video, but it is something to have in mind, the sort of dynamic and the difference between going long and going short, because that can actually have a big impact on how trading strategies work. But right, so now if I can only choose, you know, one thing you really need to learn as a beginner, I know that I feel like I say this for every slide, that it's very, very important. But this right here, risk management, is what prevents you from losing all your money. So this slide is so important. I can't emphasize it enough. As you can see right here, risk is what keeps you alive. There are way too many traders that goes into trading. Maybe they have a pretty, you know, decent strategy. Maybe they are starting to make some money, but they completely forget about risk management. And before they know it, they lose either most of their money, or you will hear, if you go to, you know, Reddit and forums, you will hear many people losing basically anything. And that is because the simple mistake that they didn't pay attention to risk management. So this is so important. And when it comes to risk management, there are multiple things included. For example, you know, always setting a stop loss is so important. This you always have to do. But some other things you really need to do is that you need to, you know, risk small. Even if you have a stop loss, if you put everything into one trade, if you put all your net worth into one trade, that is super reckless. So it's a good idea to risk small. A good strategy for beginners is to risk a certain percent per trade. So this is not something you have to do, but beginners can begin here with as small as 0.5 to 1%. And you might wonder, how do we calculate this? And I actually have created a, risk calculator that I will show you guys soon. Here, it's also important that the position size will depend on your stop loss. So the wider we have our stop loss, the less the position size can actually be. And here, an important mindset that I think I talked about a little bit earlier is that you should see losses as something that is inevitable. You will, if you trade seriously, you will have many losses. So you should see them as sort of a business expense. It's just part of the game. And another really important mindset is that in the beginning, it's actually more important that you survive than that you profit. In the long run, we as traders are we're pretty much more, it's pretty much more important to manage risk and stay in the game than to lose everything. So once again, you can think about this in poker. Let's say that you are a very good poker player. Even if you get the best hand possible, it's often not wise to go, all in right away, because you can just be super unlucky and get wiped out right away, maybe the first round. So it's very important to, size your bets wisely. But all right, so now I want to show you guys the risk management calculator, and I'm currently here on the members section of mindmathmoney.com. So here on the members section, we do have some exclusive guides and some tools and some some downloads and so on and so on. But what I want to use right now is the trading risk calculator. So this right here is a tool that you can use to, for example, you can plan your trades. Here we have the position sizer. You also have something called expected value, and we will talk about that later. You also have something called risk of ruin. But for now, let's actually focus on the position sizer. So as you can see right here, you can enter information about your account. So the standard here is 10,000. You can think about it as dollars, or you can think about it as, it doesn't really matter the currency you are using. But let's say that we have an account of $10,000. Now you can add right here what you plan to risk per trade. So if we enter 1 here, that means that we only want to risk 1% per trade. And 1% of 10,000, that is $100. And we can also choose here what we are trading. Let's say we are, let's say we're trading crypto. And here, to calculate the position size, you need to enter, your entry price. So let's say for simplistic sake that we enter at 100. And let's say that we have our stop loss at 90. Then we can simply click calculate position size here. And here you can see that our position size is 10 units. So right now we're trading crypto. It means that in order for us to risk 1%, we need to buy 10 of this cryptocurrency. You can also see here that we risk $100. You can see the stop distance, and you can see the total account exposure. If we, for example, have our stop loss instead at 80, you can see that now, because we have a wider stop loss, we only our position size is only 5 units. If you click here on settings, you can also make it a little bit more realistic. So you can, for example, add, commissions, you can add slippage and so on to make the risk a little bit more, as I said, realistic. But yeah, guys, this trading calculator, as I said, is currently available for channel members, gold and higher. So if you're interested in, getting this risk calculator and many exclusive videos and more guides and so on, you could consider becoming a channel member by clicking join. It should be a join button and next to the subscribe button on YouTube. But yeah, guys, if you don't want to, definitely don't feel any stress to do that. But if you want to, support my work and, get bonus content as well, you could consider doing it. But alright, guys, so now the next thing you really need to learn about is something called expected value. This right here is something every single poker player understands, and in my opinion, it's one of the most important things you need to learn as a trader as well. And the basics of expected value is that one trade actually doesn't matter. And you might wonder, you might ask, what do I mean by this? Well, think about it like this. Let's say you have a trading strategy with a 60% chance to win $100, and you have a 40% chance to, lose. Let me do it with red here so you understand it, to lose $100. This trading strategy, if we take this trading strategy again and again and again and again, we will eventually make money. But if we only take one trade, what can happen? Well, there's a pretty big chance that we will actually lose money. And even if we take, maybe 2 trades, maybe 3 trades, or maybe 4 trades in a row, it's still very possible that we just lose and lose and lose due to pure, unlucky. We can just be unlucky. So that is why one trade does not matter. Even 5 trades does not matter. What matters is that profitability comes from the results that are average over multiple trades. And here, what matters is both how often you win, but what also matters, and this is what most beginners just focus on, win rate, how often do we win? But what is at least as important is how much do you win compared to how much you lose. So let's say we have a trading strategy with, let's say we have a 55% risk of losing, $100. But we have a, let's say, 45% chance of winning $200, right? So here the risk of losing is bigger than the chance of winning. But since we win so much more when we actually win, this is actually a good trading strategy to take. And I will show you guys very soon a calculator for this as well. But here, in simple terms, you can lose often and still make money. And you can also win often, but still lose money. But alright guys, so now we are back here on the trading risk calculator. And now I want to head over here to expected value. So to calculate the expected value, you first need to enter the win rate. And let's actually use the example we talked about earlier. So let's use the example where we actually have, a win rate under 50%. So we actually win less than, we win less often than what we lose. Then you can choose here to use an input mode. I'm going to use the dollar here. And let's say that we win on average 200 and we lose on average 100. And here the risk per trade is auto calculated from earlier. So now let's click calculate expected value. And as you can see right here, we have a positive expected value. So for every trade, we expect to win around $33.80. And here I actually forgot to change some settings because now we have the commission and slippage. So let's just actually use 0 for these to get the exact number, save settings, and then calculate the trade again. So here, our real expected value, if we don't count with commissions or slippage, is we expect to win $35 per trade. And you also get some very interesting numbers. For example, you can see here the break-even win rate. That means that as long as we win more than 33.3%, we will actually make money over time. So let's say that we choose here maybe 35%. If this calculation is correct, we should still have a positive expected value. So let's click expected value right here. And you can see even at 35% win rate, we still have a positive expected value. But let's say if we drop down to 30% and now calculate, now it should be red numbers. And as you can see, if we have a 30% win rate, we expect to lose. And if you have a negative expected value, this is a trading strategy that you should never use, because over a large amount of trades, you will eventually lose money. And that is why I think this number right here is so important. It is the expected, value after 100 trades. So if we trade this 100 times, we expect to have minus $1,000. But if our win rate is, let me once again choose 45%, now after 100 trades, we expect to have $3,500. So yeah, guys, I hope this calculator is helpful, and I hope this helped to, teach the concept as well. And as I said, if you want this calculator, you can consider becoming a channel member by clicking join down below. But right, so now the time has come to trading psychology. And this is something that is so easy to underestimate in the beginning of your trading journey, because it's of course very important to focus on how to build a trading strategy, your risk management, and so on and so on. But when you are actually inside, when you are in the heat of a moment and maybe you see the market crashing, at that point it's not that easy anymore, and trading will basically test your psychology to the limits. And this is what I tried to demonstrate with this image right here. You can see that when it gets hard, it's so easy to just become emotional. And that is why it's important to have rules that basically protect you from yourself. We want to have rules that protect you from yourself. Very important. So a good trade follows the plan, and a bad trade breaks the rules. So, feelings like, for example, fear, this is one of the most common feelings in markets, but we have other feelings as well, like, for example, FOMO. FOMO stands for fear of missing out, and this is basically it can be, it's still a fear, but it's basically the opposite of the normal fear. This is when maybe you see, a cryptocurrency pumping, and you think that, I really need to catch this move as soon, I need to jump in, and then you jump in at the top, the price falls, and you lose a lot of money. So both of these, feelings is super, super important. And here, discipline is a super important skill as a trader. And for all of this, in this course, you can really dive deep into trading psychology, but I don't think we really have time to dive deep. But one classic book on trading psychology that I recommend reading is Trading in the Zone here by Mark Douglas. This book is far from perfect, but what the book actually is good at is, really getting the mindset right. And I actually have a full video on both trading psychology, where I especially focus on breaking down the most important principles for that book. So I'll make sure to link that video both in the video card as well as the description. So make sure to bookmark that one and add it to a watch later, because I think it's very important. But for this course, I want to keep the section about trading psychology short, because it's a long process and it does take time to learn. But I can just give you my main sort of rule here is that you will feel the emotions very strongly in the beginning. So that is just what makes risk management even more important in the beginning, and you really need to stick to your rules. But right, so now the time has finally come to put everything together here in a very, simple and beginner-friendly trading strategy. And the first rule for this trading strategy, and this I want you guys to have in mind, throughout your whole trading journey, is that many of the times I think simplicity is very powerful. So try to keep it as simple as possible. Of course, later on when you get more advanced, you can start to experimenting with indicators. Maybe you want to create your own indicators and create your own sort of automated trading strategies and so on and so on. But especially in the beginner, keeping it simple is, in my opinion, the way to go. And for beginners, what I highly recommend is to trade in the trend direction. So for most beginners, the way to go is to find a clear uptrend and trade in the same direction as the uptrend, because when we have the uptrend, the odds is pretty much already in our favor. The next step here that I recommend to trade pullbacks, and especially you can wait for pullbacks into key levels. Or what you also can do is that you can trade pullbacks that are clear chart patterns. This is another clear and beginner-friendly strategy that we will take a look at very soon. Next, what you know is that you need to define your risk before your entry. So you need to know where to enter, where to set your stop loss, and you also need to have a target. So you need to have a logical target that makes sense. And this is enough. You need one clean setup, and you need to execute the setup consistently. But right, so now we are once again here in TradingView, and we are on the daily time frame, and we're looking at gold here. And I think this chart actually gives multiple clear examples where we can trade, both pullbacks, but also, chart patterns. One of the most clear example was from an example we looked at earlier in the video. So let's actually use the replay mode. The replay mode is a tool we can use to look back, how the price have looked like in the past. So let's actually jump back to this point right here. So when we are at this point, there are a few things we can notice. The first thing we can notice is that the price, first of all, was in a pretty clear, move towards the upside, right? We printed higher highs and higher lows. But then the price started to go sideways right here. So the price went from an uptrend to basically a sideways market. But here, if we look closely at how the price reacted during this time, we could actually see here that we can identify a very clear resistance level. And remember, we don't want to draw lines here, we want to draw resistance zones. So in this case, I include this touch all the way up here, I include all of these touches, and I draw a clear resistance. What we also can notice here is that we have one low right here, we have a higher low, we have yet another higher low, and you can see that the lows are sort of getting higher and higher into resistance. So this resistance together with these lows pretty much creates what we call an ascending triangle pattern. And this is a specific pattern that gets even stronger if it appears after a move to the upside. So if we have a move to the upside and then we have this triangle pattern, then the odds is that the price will continue to the upside. But here, and this is very important, you don't want to trade this pattern until we see a breakout. And you can see that right here, the price actually broke out. And there are many rules we can use to make a breakout even more likely to succeed. And for that, to really understand both breakouts and sort of micro price movement, I highly recommend to check out my course on price action. I think it's already linked in the video card and the description. So I do highly recommend to check that one out. But for now, all you need to do is that we saw a breakout right here. And when we see a breakout, the most common way to enter is to enter at the candle close of the breakout. So remember, we used the long position tool we used earlier. So we can, for example, enter right here. And to keep it simple, let's set our stop loss below here. This is a common way to set your stop loss for the ascending triangle, below the most recent low before the breakout, and using a risk to reward ratio of 2, meaning that the target is twice the size as the stop loss. Our trade would have looked something like this. And you can see that this took actually quite a while, but eventually we locked in some nice profit. But right, so now I want to talk a little bit about practicing the right way. So how do you practice the right way as a beginner? Well, there are a few important things that I highly recommend. And two of the most important things here is to both backtest your setup on chart and trade it on a demo account. So backtesting here, the sort of first step right here, step 1, that is when you basically look at how a strategy have performed in the past, and trading in a demo account is another great way to practice. That is basically when you practice with fake money. And I talk about how to do both of these things in my full TradingView tutorial right here on YouTube. I will make sure to link that TradingView tutorial in the video card and the description. So definitely check that one out to learn how to both backtest and trade on a demo. The other thing, as I said, is to try to journal your decisions and trades. And as I said, I like to, keep a physical block, but you can, use a digital version as well. I might actually create a digital trading journal in the future. And another important thing is that you want to, of course, you want to be, data based. You want to improve based on data, and you don't want to listen to the feelings. And lastly, do not rush in with real money. That is such a, I know it's tempting to want to, really, rush in with all your money right away. Maybe you have found a trading strategy that looks like it works pretty well in the back test. Maybe you have found that you have a positive expected value and feel like, this is my time to get rich. It's so easy to just, start taking too much risk when you rush into real money. And it's also important to understand that when you use real money, the emotions you will feel will be so much larger than when you practiced on, with fake money on a demo account. So please, guys, have that in mind as well. And I highly recommend to, not rushing in with real money. Alright, so good job making it through the trading fundamentals. You now know what trading is, how to calculate risks, and how to place orders. But knowing how to press buy and sell will not make you profitable. You need to know when to press buy and sell. So next we are diving into price action. I will teach you how to really zoom in to the individual candlesticks. This is where we stop guessing and start reading the live movements of the charts. Let's dive into it. Okay, so before we can start using price action to take better trading decisions and as a result, make more profit, we of course first need to know what is price action in the first place. And here this is very important because price action is a concept that, at least in my opinion, is very misunderstood in the trading community. So make sure to really pay attention right now. So first of all, price action is all about what the price is doing right now, while another concept called market structure is what the price has done in the past. So when most people think about technical analysis, they actually think about market structure. When you look at let's say you look at a candlestick chart, when you look at a candlestick chart, what you see is actually mostly market structure. Price action is all about, the character of the price movement. So how is the price behaving right now? Is the price aggressive or not? Is the price maybe acting weak? Is it, moving? Is it volatile? And so on and so on. Price action is all about what is it doing right now. And don't worry, I will very soon show you guys a chart example of this. So what I said here, when you look at that chart, what you see, the trends, the zones, the support and resistance, the supply and demand, and so on, that is actually market structure. Price action is about reading the current candles and reading the most recent price movements. But here, it's important to learn both. Structure helps you find where to look. So for example, you might find a very important support level. This means that I should look at this level, in the future. And when the price comes down there, price action will actually give us more details. It will tell us, for example, when do we need to exit? When do we need to enter? When do we need to exit our trade? And so on and so on. So preferably, we want to use both of these together. The market structure gives us good context, but the price action gives us timing. And this is why I say that, price action is the most important thing to learn in trading. Price action is, understanding how the price moves. How is the price moving right now? And that is something you can't do without as a trader. And now to really lock in what price action is, I want you guys to look at this chart right here. And remember what I said earlier, when you look at a chart as a whole, you're actually looking at the market structure. So for example, right here, you can see that we have a nice trading range right here. We have like a strong breakout from the range. Here we have a resistance level, and here we have a support. So when you just look at this, you're actually looking at market structure. But now you might wonder, what even is price action then? Well, price action is all about what the price is doing or was doing when the price reached a certain level. So for example, when the price, you can see that we had a resistance right here. When the price reached the resistance once again, you can see that this price action is very different, or in other words, the price behaved very different compared to the price action right here, right? So for example, right here, we can say that we had, a very calm price action. You can see that the candles were going sideways. The market didn't react a lot. We can say that the price action was calm or non-aggressive and so on and so on. While the price action, right here we had a very sort of strong price action. We can say that we had lots of momentum or we had aggressive buyers. So price action is all about zooming in on what is the price doing right now. You can ask questions like, how is the price reacting to the resistance? How is the price reacting to the support? Rather than looking at the price as a whole. I usually think about price action as micro. Micro basically means that you're zooming in, while I look at market structure. So market structure MS, I look at as macro. Macro basically means that you zoom out. Now let's talk a little bit about the different parts of the candles. It's very important to understand the different parts to understand price action. And first of all, the wide part of the candle, so in other words, this part right here and this part right here, is what is known as the body of the candle, or some people call it the real body. So if you hear body or real body, this is what we are talking about. And what the body tells us, it basically tells us who is in control. And in general, a big or tall body means stronger control. So for example, if we have one candle that maybe looks something like this, as you can see, it has a pretty large real body, but the other candle might have the same high and low, but the body might be much smaller, like right here. The candle with the large body means that the buyers, or in other words, the bulls, are in control, while the candle with the smaller body represents more, hesitation, that, neither the buyers or sellers are in full control. It's a much more sort of hesitating price action. The other part you need to know about is the wicks, and the wicks are the lines, so both of these lines above the candles and both of these lines below the candles right here are known as the wicks. Another name for this is to call them shadows, but the most common name is to call them the wicks. And what does candlestick wicks tell you about the price? Well, wicks are basically all about reaction. So remember, a wick is that the price has gone up to a certain level, but then have fallen down, or it has gone down to a certain level and then it has pushed up before the candle closed. So wicks are all about reaction. So let's say that let's imagine that we have a resistance level right here, and we might have one candle that looks like this. You can see this candle has a very large wick, and it might look something like this, while the other candle might look something like this. It has a long real body and pretty short wicks. These two candles, as you can see, I tried to make them so they have roughly the same highs. You can see the highs here are roughly the same level, the lows here are roughly the same level, but they tell us very different stories about the price. On the one hand, on the candle to the left right here, we can see that the large wick really tells us that the buyers tried to push the price above the resistance, but we got rejected, and before the candle closed, we actually, the sellers managed to take control and confirmed that we had resistance. While on the other candle right here, we saw a very different story. Here, since we had a large real body, remember we asked the question, who is in control? Well, this means that the buyers were in control even past the resistance level. So this is actually an indication of something called a breakout that we will take a deeper look at later on in this course. But right, so now I want to switch the attention to take a look at one of the most important candle types you need to learn about, and that is momentum candles. If you want to master price action trading, momentum candles is something you can't do without, so make sure to really pay attention to this. And first of all, what is a momentum candle? Well, in very simple terms, a momentum candle is simply large candles that stand out. So these are candles that when you look at a chart, you will clearly see the candles and look at it and say, you know, wow, that's a big ass candle. And but here we need to have some rules for what a momentum candle is. And here, for me, I define a momentum candle as a body. Remember the real body of the candle. I define a momentum candle as that the body should be at least twice the size compared to the previous candle. And preferably, I want the real body to be maybe 3 times as large or even 4 times as large as the previous maybe 3 candles. And don't worry, I will very soon show you guys, my exact rules. And here, why do we need to learn about momentum candles? Well, momentum candles is often the very beginning. They can be the very beginning of trends. They can be the very beginning of breakouts, and so on and so on. They can be super profitable if you're able to spot them, and they are relatively simple to spot. So it's definitely a win-win situation to, learn to identify momentum candles. And here, momentum basically shows urgency. It shows that one side, either the bulls, if we have a green momentum candle, or the bears, if we have a red momentum candle, it clearly shows that one side is dominating. So what we're looking out for is a big body, small wicks, and a strong close. This really shows conviction. And here, and this is very important, if we see real momentum, what we also want to see is that we want to see high volume. And in this course, I will be talking a little bit about volume. But if you want to dive much deeper into volume, don't worry, because I do have a full course on volume analysis. I will make sure to link that video up in the video card as well as the description. So I highly recommend to check that video out after this course. Feel free to save it to a watch later playlist or something like that. But right, so now let's switch attention a little bit again, because now I want to take a closer look at how to identify momentum candles. And here on the screen, you can see that we have 2 chart examples. One chart is clearly going up, and in one chart, you can clearly see the bearish momentum candles. But first of all, to identify a momentum candle, as I said, you want to find a candle that is at least twice the size of the previous candles. And you might wonder, how many previous candles are we looking at? Well, I recommend to look at maybe 3 to 5 candles. So you want twice as large as the previous 3 to 5 candles. So let's start by looking at the example to the left here. On this example, you can see that, first of all, to identify a momentum candle, one of the easiest things to do is to simply look at the chart and take a look at the candles that stand out. And here on this chart, I think you can clearly see that these green candles right here are, they are clearly standing out. But remember the rule here, twice as large compared to the previous 3 to 5 candles. If we apply this rule, the first momentum candle in this case is probably already this candle right here, or this one is a little bit on the fence. It depends on if this one is twice as large compared to this candle right here. And remember, what we're comparing here, when I mean twice as large, I mean that the real body of the candle should be twice as large. So this one is, you know, on the fence of being a momentum candle. So is this a momentum candle? Well, maybe. But the first clear momentum candle, at least in my opinion, is this green candle right here. In this case, we can clearly see that the real body, or it at least looks like the real body, is more than twice the size of the previous candle. So it's twice the size of this candle, which automatically makes it more than twice the size of all of the previous, you know, 4 candles as well. So here we can clearly see that this candle is more than twice the size of the previous 3 to 5 candles. But now, and this is very important, now you might look at this next candle and say something like this. You know, you can see that this candle is looking even stronger compared to the previous candle, but we can see that this candle is not twice the size of the previous candle. So you might wonder, you know, in order for momentum candles to keep being momentum candles, do we need to double in size for every candle? Well, the answer to this, at least according to me, remember, this is just, I'm not saying that this is the only way or that this is the right way. This is just how I look at momentum candles. And according to me here, the momentum streak here continues as long as we are seeing candles that are either about the same size or even larger. So if this sounds complicated, you know, the streak here continues as long as the candles are about the same size or larger. So remember, this right here was the first momentum candle. This candle, we can see, is even larger. So this one is also a momentum candle. This candle is about the same size, right? It's maybe a little smaller, but about the same size. So here, this is yet another momentum candles. We have 3 momentum candles in a row. But the next candle, you can see this red candle right here, is clearly much smaller. So at this point, I reset the momentum candles. This is not a momentum candle. Now, in order to get a new momentum candle, we once again need to apply the rule. More than twice the size compared to previous 3 to 5 candles. And by applying this rule, we can actually see that the next momentum candle was this green candle right here. And now, if we look at the right side, it will probably be super easy to spot the momentum candle. If you want to, you can pause the video and spot it yourself. But as you can see, this candle right here, this red candle, is clearly the, you know, the momentum candle I'm looking out for. This one is clearly more than twice the size compared to the previous, you know, 3 to 5 candles. It's even clearly, you know, more than twice the size compared to this candle that was relatively large. And once again, this next red candle is also a momentum candle, because remember, the streak continues as long as the candles are about the same size as the momentum candle or longer. So in this case, we have 2 clear momentum candles right here. But alright, so now when we know the basics of candlestick reading and we also know about momentum candles, now we're ready to start learning about candlestick patterns. Candlestick patterns is an important part of price action, because candlestick patterns is when we zoom in on, you know, 1 to maybe a few candles and try to figure out what is the story behind the candles. What are the emotions behind the candles? If we can analyze the emotions, we can, you know, hopefully make better predictions about where the price will go, and as a result, make more money. So here, first of all, what is a candlestick pattern? Well, as I said, a candlestick pattern is a formation of one or more candles, it's usually maybe 1 to 3 candles, that creates a recognizable shape. So it's a shape we as traders can spot in the market. And what these patterns does is that these patterns show the psychology behind the price movement. It basically shows the battle here between the buyers and sellers. And if we can read the story behind the sort of psychology of the price movements, we can take better trading decisions. And here, the candlestick patterns are roughly divided into 2 categories. So first of all, we have reversals. Patterns signals potential reversals or continuation. A reversal pattern right here is simply a formation that indicates that the price is reversing from either down to up, like right here. So we might have down, then the pattern appears, and then it reverses up, or the opposite. We might have the price going up, then a bearish reversal pattern appears, indicating that the price will continue to go down. While continuation patterns, on the other hand, continuation patterns is the opposite. It's when the price goes up, a pattern appears, and if this is a continuation pattern, it indicates that the price will continue to go up. Or the opposite, if we have the price going down, the pattern appears, the continuation pattern indicates that the price will continue to go down. So we have reversal patterns and continuation patterns. And these patterns work for multiple reasons. For example, as I said, the patterns themselves tell us about the sort of psychology behind the buyers and sellers. But another reason they work is because they have become super popular. So traders around the world recognize these patterns. And because they see, let's say they see a bullish reversal pattern, they might be more likely to buy, which basically creates a self-fulfilling prophecy. So bullish patterns makes people identify the bullish patterns, which can lead to more buying pressure, which can lead to more traders learning about the patterns, and so on and so on. So there's definitely an element here of self-fulfilling prophecy. And here, and this is very important, candlestick patterns are most reliable, or in other words, they work the best when they form at key zones. So I'm talking about things like support and resistance, trend lines, even things like supply and demand, and so on and so on. And don't worry, we will talk a little bit about this in this video. But if you want to dive deeper, I highly recommend to check out my full course on support and resistance. I will make sure to link that video in the video card as well as the description. Make sure to add that to a watch later playlist. But here, the context, so where the patterns appear, usually is more important than the pattern itself. Where the candlestick pattern forms is super important, and that we will learn about in this course. But right, so now let's once again switch the attention a little bit, because now I want to show you guys the most important candlestick patterns, at least the best candlestick patterns in my opinion, and also how to trade them. So I will show you some of the most important patterns right here and how to trade them. And I want to begin here by taking a look at the hammer pattern. This right here is a pattern you really need to learn about. You might wonder why. Well, first of all, this is one of the most common patterns, and in my personal opinion, it's also one of the best patterns. So make sure to really pay attention. But first of all, is this a reversal pattern or a continuation pattern? Well, this right here is a reversal pattern. So before the pattern appears, and this is very important, we want to see a move to the downside. So in this case, we have, 1 and 2 red candles before the pattern appears. And the pattern itself is actually just this candle right here. So the hammer pattern is a 1 candle pattern. This pattern consists of only 1 candle, but remember, as I said, it's very important that before the candle appears, we want to see a move towards the downside, then the actual pattern appears, and the goal of the pattern here is to reverse the price to the upside. And now, to find the hammer pattern, we're looking out for 2 things. First of all, we want to have a small body, and remember this part right here is the body of the candle. We want this part to be, you know, pretty small, but we want the wick, so we want this part right here to be long, and preferably we want the wick to be at least twice the size, and preferably even more, compared to the length of the body. So at least twice the size of the body. We want the wick, so we want a small real body and a long lower wick. The wick here, the lower wick has to be long, and when it comes to the upper wick, so this part right here, we either want to see a very small wick or no wick at all. The best is if we see no wick, but it is okay to have a small wick. Alright, so now when we know how to identify the hammer candlestick pattern, now let's actually right away take a look at how to trade the hammer, at least, you know, the basics of trading the hammer. And here I have a chart example, and when I create videos, many of you guys are asking, you know, what time frames are you looking at, and what, you know, chart are you looking at, and it's very important to understand that pretty much all concepts I teach right here can be applied on, you know, stocks. They also work in forex, they also work in crypto. So don't worry about the time frame. You can find the hammers on daily charts, you can find them on 1 hour charts, and so on and so on. But here, if you want to, you can try to, you know, pause the video and identify the hammers yourself. Can you find any hammers on this chart? Well, here we actually have lots of hammers, but remember here that in order to, you know, have a good hammer, we want to, before the hammer appears, we want to see a move towards the downside. And here I think the most obvious move towards the downside is this massive red sort of move right here. You can see the price completely crashed right there, but after the crash we had this pattern right here, and this might not really look as a hammer. It can be a bit hard to spot, but if you pay close attention to this green candle, we can see that the lower wick of this candle is clearly more than twice the size of the body, right? And what you also can see is that the upper wick, so this part right here, is pretty small. So this right here is actually a hammer candle. It can be a bit hard to spot because, you know, the real body is, no, not super small, but as I said, the wick is still more than twice the size. And now you might wonder, you know, how do we trade this pattern? Well, the most common way is to enter, so you have your entry point at the candle close of the pattern. So your entry is usually at the candle close, and remember, for a green candle, the close is above the open, so the entry tends to be right here. As for your stop loss, if you don't know, the stop loss is the level on the chart where you will automatically sell. The stop loss is usually placed below the low of the pattern right here. So right here is your stop loss, and when it comes to your target level, you usually use a fixed risk to reward ratio. So you measure the distance from the stop loss to the entry. A common a common target level is to have twice the distance up to your target. So maybe right here. And if we use this target, which is known as a 2-to-1 target, your trade would have looked something like this, and maybe you locked in your profit right here or right here. But no, if you look more closely at this chart, you will actually be able to identify many other hammer looking patterns. For example, right here, we pretty much have a hammer. Right here, this one, you know, is maybe considered a pattern. You can see the upper wick of this one is maybe a little bit too large, but we still see that the lower wick here is clearly more than twice the size than the real body. So this one can also be considered a hammer, but this one right here is definitely considered a hammer right here. And you can see that after this pattern, we saw this beautiful green momentum candle. So this was yet another nice trade. But right, so the next pattern you really need to learn about is known as the shooting star pattern. And this pattern right here, if you look at it, it's actually pretty close to the hammer pattern. But in this case, it's a bearish reversal. So before the pattern appears, we want to see a move here towards the upside. Then the actual pattern is, one candle. It's a single candlestick pattern. And the goal of this pattern is to reverse the price to the downside. What we're looking out for when it comes to identifying the bearish shooting star is that we want to have a small real body, but in this case we want to have a long upper wick. When it comes to the hammer, we want to have a long lower wick. When it comes to the shooting star, we want to have a long upper wick, and we want this wick to be at least once again at least twice the size compared here to the real body, but preferably we want the wick to be maybe 3 times as large or even 4 times as large. The longer the wick, the better. As I said, the goal of this pattern is to reverse the price here to the downside. I can also just mention that in order for it to be a valid shooting star, we also preferably want to see either no lower wick at all, or this lower wick should be small. If you are wondering, how do I trade the shooting star, the most common entry is to enter here, to have the entry at the candle close of the shooting star. So you enter right here. The most common way to set your stop loss is to set your stop loss just above the upper wick. So this is the most common placement for stop loss. And as for target, you can use a fixed risk to reward ratio. So you measure the distance from the stop loss to the entry, and then a risk to reward ratio of 2 means that you double this distance and you lock in your profits down here. But here, and this is very important, remember that the price action is all about how the price are reacting to certain levels. So when it comes to all candlestick patterns, the context is very important. So for example, if we have a shooting star that appears here at an important resistance, so let's say that this right here is a resistance, it becomes much stronger compared to if the shooting star appears at no resistance, or even worse, if the shooting star appears in the middle of, let's say that we have a shooting star here in the middle of a trading range, then this shooting star might not even be, important at all. Alright, so the next candlestick pattern you really can't do without is known as the bullish engulfing pattern. The reason this pattern is so important is similar to the hammer pattern and the shooting star. The reason is basically that this is a very common pattern. You will notice that you will find this pattern pretty often, but that doesn't make the pattern weak. This is actually a pretty strong pattern. So it both appears often and it's also a strong pattern. So you really need to learn about it. And this pattern right here is a bullish reversal pattern. So before the pattern appears, we need to have a downtrend, right? Then the actual pattern in this case consists of 2 candlesticks. The pattern is these 2 candles right here. And as I said, this is a bullish reversal. So the goal of the pattern is to reverse the price to the upside. But now then, how do we identify this pattern? Well, here you want to find 2 candles. And the first candle, when it comes to the bullish engulfing, should be a red candle. And the real body of the red candle should preferably be pretty small. But it's not that important. And there's no specific rules on exactly how small this candle should be. What is important for the bullish engulfing, and which actually makes it a bullish engulfing, is that the green candle should open below the real body of the red candle. So here we have the low of the real body of the red candle, and the green candle needs to open below, and it also needs to close above the red candle. So you can see it closes above the real body of the red candle and it opens below. This right here is the rules for stocks. But when it comes to crypto, since crypto has no overnight trading, it is okay if the green candle opens at the same level as the red candle. So make sure to pay attention. What I mean here is that if we have, let's say we have a pattern that looks like this. First of all, we have a downtrend, then we have a red candle appear right here. In the crypto markets, it's definitely okay if you have the next green candle opening at the same level, as long as it closes above the opening of the red candle. So, and then of course the goal is for the price to reverse. So in crypto, it's okay to have a pattern that looks something like this, but in the stock market, we preferably want the green candle to open below the real body of the red candle. But all in all, what we're looking out for is a candle that sort of engulfs the previous red candle. That is where the name comes from. You can see the green candle sort of eats up the previous red candle. And now let's take a look at the bullish engulfing trading strategy. All right, so now let's take a look at how to trade the bullish engulfing, or for short, BE. So let's take a look at the bullish engulfing trading strategy. And first of all, I want you guys to take a look at this chart right here and actually try to identify the bullish engulfing pattern on your own. Did you find it? Well, here the most clear bullish engulfing, at least in my opinion, is this pattern right here. Why is this a bullish engulfing? Well, you can clearly see that before the pattern appears, we have a down movement. Then we see a red candle with a pretty small real body. And then we have a green candle that clearly opens below, right, and closes above the red candle. So this right here is a clear bullish engulfing. You can actually also see that this green candle together with the red one right here was also almost a bullish engulfing. You can actually, especially if this was a crypto chart, I would consider this a valid bullish engulfing. But this is something to have in mind, that the higher the green candle closes above the red candle, the stronger the pattern appears. So no matter the case, this right here was the stronger bullish engulfing pattern. And now you might wonder, how do we trade this pattern? Well, the first thing I want you to notice about this example is that this was pretty much a double bottom. You can see we had a low right here, and the next bullish engulfing came in at the same level. And this is something we really like to see, because just as with pretty much all price action signals, they become stronger if they appear at key levels. And in this case, we have a key support level. This right here is market structure, but it makes the signal stronger. So we have a bullish engulfing, that is one bullish sign, and we also have it coming in at a support level, that is another bullish sign. So two bullish signals at the same time can sometimes be enough to take our trade. And as for our strategy, the most common way to enter the bullish engulfing is to set your entry at the candle close of the green candle. So a common way to enter is right there. As for your stop loss, many people will set it just below the lowest point of the pattern. So setting your stop loss right there. Now my camera is a bit in the way, but you can hopefully see stop loss right there. Or another way to set stop loss is, if we have a support level like we have right here, is to set the stop just a certain distance below the support. And once again, as for target levels, we have many different methods to take targets, but one of the most common ones is to use a fixed risk to reward. And what you do here is that you measure the distance from the stop loss to the entry. You take this distance, and many times with a risk to reward of 2, you double this distance, and you would have locked in some nice profit right here. All right, so the next pattern you really need to learn about, that you might have guessed already, is of course the bearish engulfing pattern. And the bearish engulfing is, just like the bullish engulfing, but pretty much the opposite. So this right here is a bearish reversal pattern. So before the pattern appears, we need to see a move towards the upside. Then the actual pattern consists of 2 candles. So this right here is the actual pattern. And the goal of the pattern is to reverse the price to the downside. And here, the first candle of the bearish engulfing should be a candle with a relatively small green candle. And here, what I actually try to demonstrate here is that the wicks are not that important. You can, for example, see that the green candle have, a higher upper wick and a lower wick compared to this red candle right here. But the important part, just as with the bullish engulfing, is that the red candle needs to open above the real body. It needs to open above the body of the green candle, and it needs to close below the body of the green candle. The red candle needs to engulf the real body of the green candle, and when you see that signal, the pattern confirms. And just as with other patterns, this pattern becomes stronger if it appears at a key resistance. So let's say we have a resistance right here, then this pattern becomes stronger and more likely to succeed. One more thing I can mention is that if you are trading crypto, or if you're trading something where the candles don't have any overnight things, and that the candles always open at the same level as the previous close, it is okay to have a green candle that looks something like this, and then the next red candle will open at the exact same level as where the green candle close. But if you're trading, for example, crypto, it's definitely okay if as long as the red candle closes far below the low of the green candle. So this right here, let me add the wicks here so it doesn't look too ugly. This right here could definitely be a valid bearish engulfing pattern in crypto. Alright, so the next candlestick type you really need to learn about is called doji candlesticks. And as you can see here on the screen, we have many different types of dojis. You, for example, have the classic doji candle, which you can see right here. We have the long leg doji, the dragonfly doji, and the gravestone doji. But you can see that the common thing about all of these patterns is that the opening price, so right here is the open, and the closing price is actually at exactly the same level. So that is what a doji candle basically is. It is a candle that opens at one price, then it has an upper wick and a lower wick, but the candle should close at pretty much the same place as where it opened. However, if you look at this candle right here, it is okay for a doji candle to have a slight body. So let's imagine that this candle looks something like this. Maybe it also, let's say that this right here is a bearish candle. So a doji candle might have a small, either a small red body or a small green body. But the important part here is that it should open and close at around the same level. And now you might of course wonder, why are doji candles so important to learn about? Well, what a doji candle basically tell you is market indecision. Or in other words, it tells you that neither the bulls or the bears are in full control. It tells you that the market is uncertain about its direction. Or at least this, what I just said, is true for the classic doji. We actually have some dojis, for example the dragonfly right here, which is much more bullish, and we have the gravestone doji, which you can probably hear on the name, which is much more bearish. But now let's just go over these candles quickly in a step-by-step manner. So first of all, we have the classic doji. The classic doji is simply a doji candle where the upper wick here and the lower wick is around the same size. And this is one of these neutral doji candles, right, that tells you that the market is hesitating. And these signals, as with many other price action signals, when we combine them with market structure, they can be very powerful. The next doji I want to take a look at is pretty similar, but this one is called the long-legged doji. And what this basically is, it is a doji candle, but with longer wicks. So for example, in this case, we have a doji, but you can see here that the real body is a little bit higher up, and we have a very long, lower wick. And one principle you can learn about dojis in general is that the closer the body is to the top up here, the more bullish the doji will become. So for example, this example of the long leg doji is a little bit more bullish than bearish. But if let's say that the body of the long leg doji was maybe down here, then this would be a little bit more bearish than bullish. And let's think about why this is the case. Well, if we think about it, this candle opens right here. So let's imagine how the price could have looked like in this candle. So maybe, you know, it opens up here, and maybe during the candle it went up to the highest point all the way up here, but then the bears took control. They pushed the price all the way down here. But what you can notice is that before the candle closed, the bulls managed to take control and push the price all the way up to this point. And what you can see here is that if the body was even higher, that means that the bulls had even more momentum, even more bullish momentum. And that is why the placement of the body of the doji is important. And this is a segue to our next doji pattern. This right here, the next pattern is known as, it has a pretty cool name in my opinion. It's called the Dragonfly Doji. And I think that is because, you know, this candle, I guess, pretty much resembles a dragonfly. And this is an extreme example of the long leg doji, where we have the open and the close of the candle pretty much at the highest point of this candle. So this is basically almost like a V-shaped recovery. This is when the price opens down here. During the candle, the bears managed to push the price down, but before the candle closed, the bulls retook the control and pushed the price up. This is a very bullish candle. And as you also can notice, this candle is very similar to the hammer. The difference between the hammer here is that for the hammer, the bulls actually managed to push the price even higher. You can see if we include a little body right here, you can actually see that this is a hammer. The next candle is, as you will notice with many candlestick patterns, we often have a mirror version. So the opposite of the Dragonfly Doji is known as the Gravestone Doji. This is where we have the open and close at the very low of the candle. So during this candle, the price moved something like this. It started down here. The bulls started to take control, but before the candle closed, the bears regained control and pushed the price down. I'm sorry, my camera is a little bit in the way right now. Let me move to the other side because I do want to show you guys the last doji candle. This one is called the 4-price doji, and it's not, in my opinion, super important because this will be a very rare candle. But I think it's pretty fun, so let's include this one as well. This is basically when we have the open and the close at, you know, the same level, and we pretty much have no wicks. You can see this is pretty much just a straight line, and that means you know, of course, indecision. Neither the bulls or the bears are in control because neither of them have managed to push the price in either direction. But alright guys, so now it's finally time to take a look at how to use price action together with support and resistance. This right here is such a powerful tool that every trader needs to have in their toolbox to make money. But first of all here, what is support and resistance? Well, in its most simple terms, the most simple way to describe it is that a support is an area on the chart where the price tends to bounce up. While a resistance is an area on the chart where the price tends to bounce down. And here, what I'm saying here, I'm talking about support and resistance as areas or zone rather than perfect lines. Many new traders are very drawn to drawing support and resistance, no pun intended. But here, I think it's very important to right away think of them as zones, not exact lines, because in real market, you know, you will very seldom have these perfect support and resistance levels you might see in textbooks. It's much better to right away start to think about them as zones. And when we use price action together with support and resistance, what we basically do is that we watch how the candles behave when they reach important levels on the chart. And this is so important because we always have this micro macro mindset in mind. So when the price reaches an important level, we know that right now it's very important to look at what the price does. Then we analyze the price action, which tells us, you know, how should we act. The price action can reveal things like how is this support or resistance even real, or was it just fake? Maybe, you know, the price action might confirm or you know, deny our previous analysis. This is super important. So here are some principles to learn. So for example, if we see sharp reactions with, for example, long wicks, this is usually a sign that the support or resistance zone is being defended by buyers or sellers. Another thing we can look out for, we have recently learned a bit about candlestick patterns. You can look out for things like reversal candlestick patterns at key support and resistance zones. This can confirm that the level is holding. So for example, you might see, you know, a hammer at a support level, or you might see a shooting star at a resistance level. This is two examples of two very basic but important examples of combining price action with support and resistance. And here, and this is very important, the more clear the past reactions you see on a zone, the more traders tend to watch it. And this can be one of these examples where technical analysis can be a little bit of a self-fulfilling prophecy. When more traders are watching a level, that means that more traders are trading a level, and we can see stronger reactions at these levels. But another thing that is important to notice is that, and this is one thing that many traders actually get wrong, at least in my opinion, and that is that too many tests on a support can actually weaken a support level, because each touch can make the breakthrough more likely. So especially if we have a scenario where we have, for example, higher lows into resistance or lower highs into support. So let's say we have, you know, a resistance level right here, and we can see that the lows here are getting higher and higher. We have one low, higher low, higher low. This is actually a sign that the resistance is getting weaker and that we might break through. But right, so now let's dive a little bit deeper into price action together with support and resistance. And what I want you guys to have in mind throughout this whole thing is always the mindset of that price action is what the price is doing right now, while market structure is how the price have acted in the past. So let's say that, first of all, a support level is a type of market structure. So in order to have a support, you can see right here on the screen, I have drawn out a support level. But in order to have a support, we need to have the price gone there in the past. So let me draw out. So let's imagine that the price, you know, in the past, it moved down, it touched the support like this, and it moved down, touched the support like this, and then the price start to move down once again. So we have a scenario that looks something like this. And here, what we as traders need to be able to do is that we need to be able to analyze how the price action looked like when we reached the support. So for example, if we have a scenario where each time the price reached the support level, we might have seen, you know, bullish price action. And with bullish price action, I mean things like, for example, we might have seen a strong hammer the first time we touched the support, and maybe the next time we touched the support, we maybe saw a very strong a momentum candle. Remember, a momentum candle is a candle that is at least twice the size compared to the previous candles. So we measure the previous candles and we see that we have a momentum candle. The price action of the previous touches makes this more likely to be a strong support. So this makes it more likely that when the price, or if the price eventually comes down to this level, we are really paying attention to this support level. But now, and this is even more important, when the price actually comes to this level, we need to analyze what happens to the price when we reach this level. So if we see, let's once again take an example from earlier in this course. If we go to this level and let's say that we see a strong, remember, a strong bullish engulfing pattern, this right here would be a very good sign, because this is bullish price action coming in at a level where we have previously seen bullish price action. And as the saying goes, you know, history doesn't repeat, but it definitely rhymes. This is a good sign and a sign for us to potentially look out for a trade, right? But if we instead, let's imagine that we have a scenario where when the price comes down here, maybe instead of having a bullish engulfing, we maybe see, you know, let's say we see a doji candle right here. We maybe see 2 doji candles in a row. After that, we maybe see, you know, a green candle that looks something like this. This is a candle known as a spinning top. All of these candles together, what does this candle tell you? Well, they definitely don't give you any confidence about this support. It actually tells you that on this support level, the buyers and sellers, neither the buyers or sellers are in full control. And this can actually be, or this is, a bearish sign. And here it gets even more sketchy if, you know, if you look at the price action of the previous touches. I accidentally deleted it. But if we look at the price action of the previous touches, and we notice that these touches as well maybe wasn't as convincing. Maybe instead of a hammer, we might have had, you know, a candle that looks more like, you know, a spinning top candle, and maybe the bounce also didn't have, you know, super convincing candles. Maybe it looked something like this. This is not as bullish as the hammer, and maybe next time during this phase, during this bounce, we maybe had also, you know, a few doji candles and, you know, not as convincing candles. This will once again make this support less significant and less likely to succeed. So here, I hope you start to realize here the difference between price action and market structure. Price action, we're talking about how the price moved. But we can talk about, this is a bit hard to understand, but price action, we mostly think about how the price is moving right now. But we can also talk about price action when we zoom in on how the price has moved on specific points. It's all about, you know, really zooming in on the price. But all right, so here are some rules you can write down in your notebook, because you are taking notes, right? Don't worry if you don't do that. But here is a few rules that you can look out for in order to find strong support levels. So the first thing we're looking out for is that we want to see a sharp reaction and preferably a long wick. So here we're looking out for, you know, the classic example would be, you know, a hammer pattern. But any kind of pattern where we see a strong wick is a sign of, you know, if we're talking about support, that buyers step in, or if we are talking about resistance, that sellers stepped in. What we also can look out for is other types of clear reversal candles. So I'm talking about things like the bullish and bearish engulfing pattern. You can look out for things like the dark cloud cover. You can look out for piercing patterns, momentum candles. There are so many candlestick patterns you can learn. And if you want to dive even deeper into candlestick patterns, I actually have a full 2-hour long course right here on YouTube. I will make sure to link that video up in the video card if you really want to dive deep. I actually highly recommend to check that full course out after this video, so make sure to save it to a watch later playlist or something like that. Yet another sign is that the price moves away quickly with strong candles. So you don't only want to look out for the single candle that touches the support, you also want to look out for the candles that comes afterward. So for example, if we have a hammer like we see right here, and after the hammer we might see a strong bullish engulfing pattern, then this makes the support even more bullish. It shows even more strength. And here, the next thing is that quick reaction is strength. We're looking at, remember, price action is all about the character of the movement. So if we have the opposite, if we have, you know, slow hovering around the level, so if we have a resistance and the price comes up here and then maybe moves around the resistance for a long while, this is a sign of weakness rather than strength. And here, let's quickly take a look at the opposite. What are the price action that shows up before a support or resistance level breaks? Well, the first thing I'm looking out for is lower highs pressing into support. So this is a scenario where we have a support level right here, and we see that the highs here coming into the support are getting lower and lower. This is a sign of weakness, and the opposite is true for the resistance. So if we have the resistance and we have higher lows pressing into the resistance, that is a clear warning sign that the resistance might be breaking. The next thing I'm looking out for here is small candles clustering near the level. So this was what I showed earlier when we see indecision candles like doji candles or spinning tops coming in at support or resistance levels. This indicates that, you know, the analysis wasn't what we thought. When we drew out our support and resistance levels, what we expect is to see a strong reaction. So if we get evidence to the contrary, this is of course a bearish sign. And here, and this is very important, when we see rising volume during weak tests, that's a bearish sign. But when we see rising volume during strong tests, so if we, for example, see a bullish hammer pattern or momentum candle, that is a good sign. In general, you can think about volume as something that confirms the move. So the more volume we have on a candlestick pattern, the more strong it tends to be. So if you have lots of volume on a bullish move, it becomes more bullish, but if you have lots of volume on a bearish move, it becomes more bearish. Last but definitely not least, and this we will talk about more soon, is that if we see, you know, momentum candles breaking through, you know, with especially with conviction, that is of course a very bearish sign. But right, so now let's switch attention and take a look at one of my favorite ways to trade, and that is how to trade breakouts. And now you might wonder, you know, why do I like breakouts? Well, the exciting thing about breakouts is that, you know, a breakout is when the price quickly moves beyond a key level. So that is an opportunity, because we see so quick movements, that is an opportunity to make quick money. You can get in and out of the market quickly and make some nice profit. And these kind of breakout trades is very exciting and so on and so on. But because they are such violent moves and can be exciting times, that makes it even more important to, you know, really learn about them. And that also makes it very important that you have a good psychology, a good trading psychology before you start trading them. But now let's take a look at how to trade breakouts. Well, there are a few things we're looking out for. The first thing we want to look out for is a strong momentum candle breaking beyond a level. This is pretty simple. Let's say we have a resistance level right here. What we in general are looking out for is that we want to see a strong momentum candle with at least twice the size of the previous candles. Preferably when we see breakouts, I really recommend to see, 3 times or even more compared to the previous candles, but that is the first thing we're looking out for. And another key thing is that we want to see the candle, it should close clearly beyond it. So the candle close, which in this case is up here, it should be far above the resistance. We don't want the candle to look, something like this. Even if it's a momentum candle, we don't want the candle to close near the resistance. We want to close it far above. The next thing we want to see is that we want to see lots of volume. I mentioned this briefly earlier in the course, but what volume basically tells us is how many market participants are supporting the move. So if we have a strong momentum candle and lots of volume, it means that many traders participated and agreed that this is a real move. But if we have a strong momentum candle and we have little volume, it means that, yes, maybe we had a momentum candle, but we don't really have lots of people causing this move. So maybe it's not as significant. And the other point I want to talk about here, it's a very, casual point, but it's actually very important. And I will show you guys a super clear example in TradingView soon. And that is that the level being broken should be obvious to everyone. The more obvious the break is, the more likely it is that we see strong price action coming into that level. So if you are, and this is why, trading maybe on the larger time frames, like maybe the daily chart or the 1 hour chart, can often be more, basically more profitable, or at least easier to trade in many cases, because these are levels that more traders are paying attention to, and it can lead to these strong reactions. The next thing I'm looking out for is follow through candles. So even after we see the breakout candle, what many traders like to do, let me delete, let me take back the level right here. But what many people are looking out for is a confirmation candle. So even after the breakout, some traders wait for one more momentum candle before they actually enter the trade. Here, the next point is just one way to trade breakouts, and that is that you can wait for a retest of the broken level. So this is basically when we have, let's say we have a resistance right here, the price breaks above. A common entry point is to wait for a pullback and then try to enter right here. And once again, the same principles as with normal support applies, because when we break resistance, many times it flips to become support in the future. So what we want to look out for here is some kind of bullish price action coming in to that support. But right, guys, so now let's actually jump into TradingView. If you didn't know, TradingView is the platform I use for all my technical analysis. I actually also use TradingView for my fundamental analysis, news, and basically all things trading. And if you want to follow along for the rest of this course, later on I will show you guys some indicator and much more good stuff. Make sure that you have TradingView, and if you want to, you can definitely. TradingView has a good free version you can use, and it does include most things I will cover in this video. But if you want to get access to everything, don't worry, because I do have a special link. I will make sure to leave that link in the description and the pinned comment, and you can use that link to try out TradingView Premium for free for 30 days. And if you, after that trial period, decide that you really loved TradingView, you can, continue that and get a $15 bonus. So make sure to use that link if you haven't used it already. But now let's take a look at one of my all-time favorite breakout examples. But first of all, right now we're looking at Bitcoin. You can see it up here, and we are on a daily time frame. So every candlestick on this chart represents 1 day. But the breakout example I want to show is actually one that happened a long time ago, because I really, this example is so clear. And that example actually comes from breaking the old all-time high from all the way back in 2017. And remember the rule we talked about just recently. One of the key rules we're looking out for when we're looking out for breakouts is that if we have an obvious level, or in other words, we have a level that, you know, pretty much everyone is paying attention to, it's more likely that we will see a strong, you know, reaction at that level. And I think it's no better example than showing, you know, when Bitcoin broke the all-time high. So you can see here, back in 2017, Bitcoin got rejected here near 20,000. It was at around 19,700. We got a clear reaction 2 times, and it took a very, very long time before the price revisited this level. But you can see that eventually in 2020, the price tried to break this level again. And you can see that first of all, we failed. The price came up to this level, but we didn't see any signs we talked about earlier of a breakout. You can see that the price actually briefly pushed above. I hope you can see the wicks. We wicked above quickly, but this is no evidence of a breakout. And also remember that we're looking out for volume, but during this try of breaking out, we didn't have lots of volume. By the way, if you don't know where to find volume, what you basically do is that you go up here to the indicators tab in TradingView and you search for volume. There are tons of different volume indicators. Some are built by TradingView and some are built by the TradingView community. That is one thing I really like about TradingView, that it has a very large community. People are building indicators. So you can, you know, use other people's indicators and strategies. But for this video, I'm going to keep it simple and open up the normal volume indicator right here. But you can see that during this time, we had all of the signs that the breakout maybe wasn't going to happen. And it also got proven. We didn't see a breakout. And the price actually dropped down a bit here. But on the next attempt, on this day right here, on December 16, 2020, we actually saw all the signs of a strong breakout. First of all, right here, what type of candle is this? Well, this right here is a clear momentum candle, right? Because it's clearly more than twice the size of all of the previous candles right here. This is a super clear momentum candle. The next sign we're looking out for here is the volume. I think this was this volume right here, but you can see that we clearly have, you know, more than twice the volume of all the previous days. Another sign here, remember, another sign we're looking out for is that we want the candle close to be far above the resistance, and in this case, the candle close was clearly far above the resistance. And the last sign that I talked about earlier was, of course, that this is a level clearly visible to everyone. Everyone was paying attention to this level. So when it actually broke out, we saw lots of strong bullish price action. And the reason I love this example is that after this breakout, we saw the beginning of one of the most legendary bull markets of all time. So this right here, you know, it's important to mention that every time you trade breakouts, you will of course not find these kind of perfect examples, but I do think this is a perfect example that really demonstrate all of the principles I talked about earlier. But right, so now when we know about the signs to look out for when it comes to breakouts, now it's easy to also learn about signs that a breakout will fail, or in other words, signs of false breakouts. So what we can see here is that if we basically take a look at the opposite of what makes a breakout strong, we can actually find these false breakouts. So the first sign we're looking out for is a weak breakout candle. So if we have a breakout candle that is, you know, not a momentum candle, it's not convincing, that is a sign that a breakout will fail. Another very clear sign is if we only see a wick above or a wick below a level, that's a clear sign of reversal. So if we, for example, have a resistance and the price comes up and then we see, you know, a wick above. This is of course a clear example of a reversal, and as you can see, this right here pretty much looks like a bearish shooting star, which in itself is a bearish candlestick pattern. One thing that is very nice about technical analysis is that when you dive deeper, you will start to realize that pretty much all bearish patterns and all bullish patterns, when you learn about the principles that makes the patterns bullish or bearish, it will all sort of pretty much make sense without even learning about the patterns. That is a cool thing. But on my YouTube channel, you will find everything you need to know about technical analysis. Hopefully, I do constantly create more content as well. But that is one sort of magical thing about technical analysis. But here, another clear sign. Remember, in order to have a good breakout, we want to see lots of volume. So a sign of a false breakout is if we don't see an increasing volume. Because breakouts, we want many traders to pay attention to them. And if we don't see increase of volume, it's a sign that not many people are paying attention and that we might not see the increase in volatility we do expect. Of course, another sign is if we see immediate opposite candles form. That is a clear signal of a trap. And one thing you really know about false breakouts is that these are not just moments where we should be careful about. False breakouts can actually be one of the best opportunities to trade and one of the best opportunities to make money. Some of my favorite trading strategies actually involves trading these false breakouts. So they are super important to be able to spot, not only to avoid them, but also to trade them. But alright, so now let's actually jump back here into TradingView. We are still looking at the exact same chart and same example as before. And now I actually want to go down to the same spot we looked at earlier, because I do think this is a good example of a false breakout. So remember the point on the chart we talked about earlier. Bitcoin reached a new high right here. This was all the way back in December 2017. But what you can notice is that the price actually tried to break out right here. You can see that, I hope you can see that red candle. I can actually zoom in on it a little bit more. But this was an example for the price to break even higher. We actually wicked above here, so this was a clear attempt. But this breakout had many of the false breakout signs. The first sign is that we wicked above, the price didn't even close above the levels. That is a clear warning sign. Another clear warning sign is that if we look down here to the volume, we saw no increase in volume. We actually saw one of the smallest volume bars, and that is a very strong warning sign. You know, and because we only wicked above, we also, of course, we didn't have a momentum candle. In fact, this was one of the weakest momentum candles of this whole rally. So we had just so many signs that this was not a good breakout. And actually, after this pattern appeared, you can actually see that this was the beginning of the downfall of Bitcoin. After this period, we actually started a strong trend towards the downside. But alright, so now I want to talk about something super important, and that is why volume is so important when it comes to price action. It's not only important when it comes to breakout, it's actually one tool we can use for all price action. But first of all, what does volume actually tell us? Well, volume basically shows us how many traders are active during a certain move. So let's, for example, go back to our examples of candlestick patterns. If we see a hammer pattern right here, and we have, you know, lots of volume, it means that many traders were active during this hammer pattern, and it makes the hammer pattern more significant. So as I said, high volume confirms that a move is strong and supported, while low volume means that we have weak participation. And the weaker volume, the more you should be skeptical about what you see. This is at least how I think about it. I'm not saying that I'm correct. This is my way of really understanding volume. So here, if we have rising price with falling volume, or in other words, we have a divergence between the volume and the price, this can be a bearish signal of trend exhaustion. And if we, for example, have big volume spikes at highs or lows, this can make them more important points. It can, be a signal that we as traders should pay attention to these points. And here, when it comes to volume, there is a little bit different when it comes to, crypto, stocks, and forex. In crypto and the stock market, volume is pretty simple because we have, very clear volume data. For example, the volume in stocks is how many stocks got traded during that period. In crypto, it's how many of that specific coin got traded. In forex, we use a little bit different, a different measurement, which is not as accurate. But what I do want to measure, we often use something called tick volume. But what I do want to mention here is that you can use volume in forex as well, but it's a little bit less, how to put it. The data is a little bit more tricky in the forex market. All right, so here to just dive a little bit deeper and to really hammer in the concept of price action and volume, I want you to just look at these two candles right here. And what I want to demonstrate is that we might have, let's say that these are two different worlds, two parallel universes or something like that, and that these candles are exactly the same. You can imagine that this is, let's say a stock, a candle of a stock. But in one scenario, we might have, let's say we have a volume of 10, while in the other scenario, we have a volume of 10,000. And here, even though these candles are exactly the same, so if you only look at the candles, you might say that these are two, they tell us the exact same thing about the price, but this is actually far from true. Because in one candle, this might be, in a very, very small stock. And let's say this candle might have been created from only one trader buying, let's say a very small stock. Just one trader bought a stock and it created the volume of 10 and this candle right here. So this candle was only created by one trader. But if we compare it to the candle of the right, in order to create the candle to the right, we would actually need to have 1,000 of the same trader in order to create this volume, because 1,000 times 10 is 10,000. So while the candle to the left might have been created from one trader, in order to create the candle to the right, we would have needed 1,000 of that same trader. So I really hope this demonstrates the principle and it shows you the reason why the candle here to the right is more significant, because there are more traders agreeing that this is a valid candle. There are more market participants participating and supporting that move. But alright, so now let's actually jump back into TradingView, because now I want to show you some of the best price action trading indicators. And now you might wonder, isn't price action all about trading without indicators? And if you haven't followed along throughout this course, you know that price action is all about, zooming in and taking a look at what the price is doing right now. And we can actually, there are a few indicators you can use that can help you with that. So now I want to show you some of my favorite indicators when it comes to price action. And I think most of these indicators are available on the free TradingView plan, but some might be, you might need TradingView Essential or TradingView Premium for some of them, but don't worry, because I do have a special TradingView link. You can use that link to try out TradingView Premium for free for 30 days. And if you, after the trial, think that TradingView is good enough and you want to continue using it, you will get a $15 bonus. So make sure to check out that link. It will be in the description and the pinned comment. But alright guys, so now let's take a look at the indicators. And the first indicator I want to take a look at, let's actually open this one up right away. And to open it, you want to go to the indicators tab in TradingView up here. And then you want to type in a star, and then you want to search for all candlestick patterns and then a star right here. And as you can see, when we search for this, you will see multiple indicators appearing here. Some are created by the community, but the one we want to open is this one at the top called all candlestick patterns. And here, one thing you need to notice is that, or one thing I have read in, for example, YouTube comments, is that some traders have problem finding this indicator. So if you for some reason don't find this indicator, try to search for it in your own language. That has been helpful to some people, but hopefully you can find it right away. So now let's open this one up. And as you can see, after opening this one up, you will see multiple buy and sell signals appearing here on the chart. And you can see the red sort of dots right here, right here, right here, right here are sell signals. And we also have buy signals, the blue ones right there. But now, in order to use this indicator effectively, I like to change a few settings. So to do this, we want to go up here to the cogwheel where it says settings. And as you can see, when you open up the settings tab, you can see that we have tons of different candlestick patterns we can choose between here. And what this indicator basically does is that it automatically detects candlestick patterns. In this course, we have learned about a few, and these are the ones I do want to choose here. So remember, we learned about earlier, we learned about the pattern. So I want to, earlier we learned about the hammer. So I want to choose the hammer, but we also learned about the shooting star. So I want to make sure to have the shooting star. We already have the engulfing pattern right here. We can actually uncheck the dojis for now because I do want to focus on reversal patterns. So we have the engulfing, we have the hammer, we have the shooting star, and I think that is good for now. The other setting I want you to pay attention to is that you can see it says detect trend based on. And this right here is actually a filter that filters out some of the false signals. Because remember from earlier in the course when we talked about candlestick patterns, in order to find significant, for example, in order to find a valid hammer pattern, you want to have a downtrend before the pattern appears, because the goal of the pattern is to reverse the price to the upside. And what this setting can do is that it can help reduce some of the false signals, because if we click on no detection right here, you can see that we will have many more signals appearing on the chart and it's more noisy. So I actually like to have this detect trend based on SMA 50. This right here is a simple moving average based on 50 days. And as I said, it helps to reduce some noise. So now I want to go down here and press OK. And as you can see, we have many nice signals appearing here on the chart. Some are better than others. You can, for example, see that this sell signal right here was beautiful, because after this signal we saw a strong move towards the downside. This bullish signal right here was also nice. We saw a very nice move. This bullish signal was pretty good, and so on and so on. But if you want to make these signals even better and even more significant, what you want to do is that you want to combine them with key market structure. So now I actually also want to show you guys one of my favorite indicators to find important market structure. Market structure is in general a very broad topic, and I do actually highly recommend that you dive deeper into market structure. I do have a full market structure trading course right here on YouTube, and I will make sure to link that course both up in the video card as well as the description. Make sure to add that one to a watch later playlist. I highly recommend to watch it. But for now, let me actually show you this indicator that you can use that can really help you identify market structure. So once again, we go up here to the indicators tab in TradingView, and then you want to search for pivot points high low. And just like that, once again, you can see we have tons of indicators appearing, but the one you want to use is this one at the top that is created by TradingView. So you open this one up, and as you can see, after opening this indicator, you will see multiple points here appearing on the chart. And you can already notice that these points tend to be at pretty, nice high and low points. But before we can use this indicator effectively, I need to change a few settings. So what you want to do now is that you want to go up to this indicator where it says 10 10 10, and you click on the cogwheel tab, you click on the settings tab, and now the settings I like to use is to change the pivot height to 20, the pivot height to 2020, and also the pivot low to 2020. And since I'm using white TradingView, I really like to change this one to white black, this one to white black. This is just visual to make the signals much more clearer. And now I can also just mention what this pivot high and pivot low means. These numbers 20 and 20 are basically how many candlesticks this indicator use to make its calculation. So 2020 means that it uses 20 candles to the left and 20 candles to the right to find these significant points. So now we're ready to click OK. And here, these, first of all, you can now see that we have less points, but at the same time, these points will be more significant. And if we find areas on the chart where we have multiple of these points, they tend to be key support and resistance levels. So for example, if you take a look right here, you can see that we have a point. We saw actually a strong reaction and strong selling pressure coming in. So what we can do is that we can actually try to see if we have some resistance from this level. If we include all of these 3 wicks from the 3 touches of this high and drag this one to the left, to the right, you can see that we saw this massive reaction here. And remember when we saw lots of bearish price action coming in, and this can actually make this resistance becoming more significant in the future. So we saw this strong selling pressure coming in, the price went down, and then we actually came up and retested this resistance. And what you also can notice is at the same time, this candlestick indicator automatically identified a bearish engulfing pattern. And as you know by now, the bearish engulfing pattern is a bearish reversal candle indicating a move here towards the downside. And after this move, the price completely collapsed here. But now you might of course wonder, okay, so great, you are using indicators, but how could I actually have traded this? Well, to trade this bearish engulfing, since it is a bearish pattern, what we're looking out for is actually going short. Going short is when you make money from the price going down. I do have a video about that if you want to learn more. But what I'm going to do is that I'm going to open up the short position right here in TradingView. If you have been following the course, you know the most common entry point is to enter at the candle close of this pattern. As for your stop loss, you can either set your stop loss just above the pattern or above the resistance level. For now, let's keep it simple and set the stop loss just above the high of the bearish engulfing. And if we use a risk to reward ratio of 2, our trade would have looked something like this. We would have locked in some very nice profit, but in this case we could have used a much broader stop, for example a 3-to-1 stop as well. If we look a bit more to the right, let's actually see if we can find another example. Here, this is actually super interesting because we do have a pivot point right here, and we saw a move towards the upside from that pivot point, so we can draw out some sort of support right here. And you can see that recently we actually saw a strong move towards the downside. By the way, I'm currently, I think I forgot to mention it, but I'm currently looking at SMCI, a stock here, an AI stock on the daily time frame that has been having a hard time lately. But what you can notice is that we actually saw just recently a potential. I would actually say that this is pretty much like a dragonfly doji, and you know that that is a bullish candlestick signal. This is pretty much like a mix between a hammer and a bullish dragonfly doji, and this actually indicates a potential reversal to the upside. This right here is a live market, so we don't know if this one will reverse or not. Remember, and this is super important, trading is not about certainties. It's all about probabilities. We as traders try to get the probabilities on our side to take better trading decisions, and as a result to make more money, but we can never be certain. So we don't know if this one will play out. But we do have a bullish signal right here. And in order to find, you know, how to trade this one, first of all, it's a bullish pattern, so we want to use our long position here. So we use our long position. The most common way to enter is to enter at the candle close. Once again, the stop loss in this case I would definitely set below the extreme of the pattern, so we set it just below the lowest point of the wick right there. But here, as for the target level, I actually want to show you guys another indicator you can use to help find targets and where to lock in your profit. And so now we once again want to open up the indicators tab in TradingView, and now I want to search for volume profile. Remember, earlier in this course we have already talked about volume. We know that volume is all about confirming, you know, how significant is a move. But we don't, what we have been talking about recently is how much volume do we have on each candle. But what you also can analyze is how much volume do we have on each level. And this is where volume profile comes in. And here, when you search for volume profile in TradingView, you will see that we have tons of different indicators. We have also multiple indicators created by TradingView, and these are all for slightly different scenarios and reasons. But in this video, I want to use the fixed range volume profile, so you want to open up this one right here. And what this indicator allows you to do is that it allows you to show you a range. So you see you have two white dots here, and you can choose, for example, to measure you know, this whole part right here. But for now, I want to analyze the most recent swing move, and the most recent swing move is from the pivot point here down to the most recent low. So you can see that I put the first dot up here, and then I drag down the second dot down here. So I analyze this whole move. And the reason I want to do this is because, as I suspected, you can see that during this whole part where the price was dropping down fast, here, while we do have lots of volume on the individual candles, we don't really have lots of volume on the horizontal level. You can see that most of the price, this is actually around 70% of the volume got traded during that part. And this makes it, I don't really have time to explain this in detail, but this makes it so that, you know, because the price went down quickly right here and we didn't have lots of volume, it means that if we get a bounce here, it's likely that the price can, without much resistance, push up to this point. Here is where it's more likely that we do get some more resistance. Often traders talk about that these sort of value areas on the volume profile can act as magnets. This is, you know, a little bit, you can argue if that is true or not, but in general the price tend to move more freely where we don't have lots of volume. So one argument could be made here to, you know, set the target level below the value area of the volume profile. But as I said, you know, this is a little bit outside the scope of this video. You know, analyzing volume can really help your analysis. But if you want to dive deeper into volume analysis and really looking at how the price is behaving within the candles themselves, then I highly recommend to check out my course on order flow trading. I will make sure to leave a link to that course up in the video card as well as the description below. Alright, so congrats, you now know how to read the micro movements of the chart and the battle that always goes on between the bulls and the bears. But here is the trap that wipes out so many beginner traders. Trading a candlestick in the middle of nowhere will lose you money. For example, a bullish pattern only works if you trade the pattern at the right location. So what we now need to do is that we need to zoom out. And this is where market structure comes in. I'm going to show you how to find and map historical trends, ranges, and key zones. And this will show you exactly where to look for these key price action signals we talked about earlier in the course. If you skip learning about market structure, the price action signals won't work. So make sure to really lock in for the next part. Let's jump right into it. Alright guys, so now let's start here with module 1, which is just a fancy word for chapter 1. And what you will learn here is what market structure is and the key distinction between macro versus micro structure. This is basically, as you can see right here, the 2 layers of every chart. So make sure to really lock in here. So first of all, what market structure is basically the big picture of the market. This is when you zoom out and look at the market as a whole. So you can see this is the big picture of the chart. It shows the major highs and lows. It shows you the trend direction. So are we in an uptrend, downtrend, or sideways market? And basically the overall path. And as I mentioned earlier, you can think about this as the skeleton that gives shape of the market. So when you look at, as an example, when you look at, a market, it might look like something like this, right here, you can see that we have an uptrend, right? Then maybe the market starts to go something like this and maybe like that. All of this, when you look at this right here, this is market structure. But then we have the details. The details here is what is known as price action. This is the small movements inside each swing. So things like, candles, candlestick patterns, small micro movements, are we seeing momentum or not? So for example, imagine that you look at this chart I have right here and you zoom in. So let's say that you zoom in on where the price is, right now. And maybe you can see that we have right here, maybe we have a strong red candle. When you zoom in like this and look at the candle itself and the character of this candle, this is price action. So the difference between market structure and price action is basically if we look at the market as a whole, or if we zoom in and look at the character of the movements. So I really hope this makes sense. So to hammer it home here, the key takeaway is that market structure is basically the macro structure. It's maybe I should have used another word, but it's where we are in the market and the overall picture of the market, while microstructure shows what is happening right now. So we use price action to get more precise entries and maybe even get hints on where and when to exit the market and lock in some profit. Alright, so let's actually right away jump into TradingView right here. TradingView is the platform I use for all my technical analysis, all my trading, and it is the platform I will use throughout this course. And if you want to follow along and be able to do everything I do in this course, I will have a link to TradingView both in the pinned comment and the description, and you can use that link to try out TradingView Premium for free for 30 days. And after the trial, if you like it, you can continue, or you can actually move to the free version. But the free version does have ads and have some limitations, but I think especially if you are a new beginner, the free version is definitely good enough to start off. But here, as I said, I'm currently looking here at a Google chart. You can see that by looking up here. You can see we're looking at Google and we are on a daily time frame. So right here, every candlestick represents 1 day. But I can already mention that the concepts in this video you can use on the daily time frame, but also on the 1 hour time frame, even the 5-minute time frame. They are basically universal. So don't really worry about the time frame. But what I just simply want to start off by showing you guys is the difference here between market structure and price action. So if we were to analyze the market structure of this chart, the absolute most basic, and that you guys hopefully can see by just looking at this chart, is that we are in an uptrend. You can see we are in an uptrend because the price is printing, you know, we have a high and low, then we have a higher high, we also have a higher low, a higher high, higher low. So when we look at the market structure, we look at the market and say we are in an uptrend. However, if we want to analyze the price action, we can, for example, analyze, you know, what happened just recently. For example, right here, we actually almost have a specific candlestick pattern known as a bearish engulfing pattern. I would say not a perfect one, but almost a bearish pattern right here. And included in price action, you can also do things like analyze, you know, what happened at specific points. So for example, when we broke out of this pullback right here, you might want to analyze, you know, the micro movement of that specific point. That is also price action. So price action doesn't have to be only the last candle. You can analyze things that happened in the past, but it's all about, you know, how you zoom in and that you look at specific micro movements. Alright, so now it's time for module 2 right here, and now we will learn about swing points and market extremes. These are very important points to learn about because these are basically the building blocks of market structure. So first of all, let's define what a swing point is. When it comes to swing points, we actually have 2 swing points, as you can see right here. We have the swing high, which is basically a peak where the price turned downward, and this can mark potential, you know, resistance and reversal zones. And then we have the swing low. This is the opposite, a valley where the price turned upward. And this marks the opposite. It marks support and potential bounce zones. So when we have a market, let's once again draw out a market here. Let's say we have an uptrend as the chart we recently looked at. Here, it's super simple to find the swing high and swing low. For example, right here, we have a swing high. We can mark it with an H. Right here, we have a swing high. We can mark it with an H. And right here, we have another swing high. Here, we have a swing low. Right here, we have a swing low, and so on and so on. And this is the basics of swing highs and swing lows, and it's super, super simple. And in order to have an uptrend, the definition of an uptrend is that we need to have both consecutive higher highs and consecutive higher lows. So when we have, you know, 2 higher highs and 2 higher lows, we can consider an uptrend to have been started. But here it starts to get a little bit more complicated because, you know, markets, as you probably know, markets are very seldom this simple. You know, they are not always, you know, perfect uptrends or perfect downtrends, because within each swing, I can also mention that these are swing points and the actual moves right here. So for example, the move from this point to this point is what is known as a swing. And what you need to learn is that we have minor and major swings. And here, the swings you can see on this image right here are actually major swings. These are the sort of big moves in the markets, the moves we think about, you know, when we look at a chart as a whole. But we also have something called minor swings, and this makes everything more complicated. Minor swings are basically the small moves and the small turns inside each move. So what you will notice is that inside of each move, you will actually see that each move have sort of swings themselves. So you can see this red part right here is like a swing within this move, and this will be especially apparent when you zoom in on shorter time frames. And when you zoom in even more, you will also notice that this, you know, swing within the swing will have sort of moves like this as well. I hope this makes sense. This is basically what is known as fractals, meaning that when we zoom in on one part of the structure, you will see the same structure appear. So let me try to show this. If we create the first part here as green, I hope you can see that the pattern here is the same for all of these colors. The green one, the red one, and the blue one is the exact same pattern, where we have a swing, we have a pullback, we have a swing, and within each swing we have the pattern itself. And this is very, very cool, and this is how market works. And this is also a reason why many things, pretty much most things you learn about technical analysis, actually works on all time frames, because the market behaves the same, you know, no matter how you zoom in. With a small, you know, I wouldn't say exactly the same. There are some small differences between if you trade on the daily time frame or the 1 minute time frame, but largely I would actually say that it is the same. And why does it matter? Well, swing points and understanding this makes charts so much easier to read. You know, as a beginner, it can often be super overwhelming to, you know, open up a random chart and you have no idea where you are in the market. By understanding these swing points, it becomes so much easier to read. So here is a little tip and kind of an exercise for you guys. I want you guys to open up a chart and start by marking out only the major swings of the chart. So take up a chart on TradingView and, you know, mark up the large sort of structure of the chart. Don't worry about all the minor swings, mark up the larger swings. So here, let's actually once again jump into TradingView, and I'm once again looking at Google on the daily chart, and I will actually try to use this chart as much as possible in this video, so you guys can learn that these concepts are very general. You can apply them to any kind of chart. But now, what I want to do is to simply mark up the major swings. So as you probably can see, and don't worry, you will learn mechanical rules for how to do this later. But for now, let's just mark up the swings we can see. First of all, this one is very clear. We see a swing up right here, but then we see a pullback. The next swing is also pretty clear. Then this one is a bit harder in my opinion, but you can see that the price indeed pulls back. It's a little bit more messy, but then we see another move and then the price pulls back. But now you can also see that within swings, especially some moves are very clear. So for example, right here, you can see that within this swing, we actually have like a move down here, a move up here, and then a move down here. Once again, in the next swing, we have a move like up here, then it goes down here, then it goes up here, then down here, up here, down here, and so on and so on. So you can see that within the moves, we have these minor swings. And you can't really see it right now, but even on the parts where it looks like a straight line, so for example, right here, you will notice that if you zoom into the shorter time frames, maybe all the way to the 5-minute time frame, you will actually see that this is a trend in itself with its own, you know, swing moves up and down. All right, so now let's move on to chapter 3 right here. This is one of the most important chapters, so make sure here to really pay attention, because here we will learn about the impulse plus pullback pattern. And this is basically the sort of fundamental heartbeat of every single trend. So this, if you learn this, you basically learn how markets move. And the core concepts here, the important concept to learn is that markets moves in waves. Every trending market follows the same rhythm. Strong moves followed by pauses. And if you are and understanding this pattern is the, as I said, foundation of all of all trading. And the two kinds of moves you need to learn is, first of all, the impulse move and also the pullback. So for the impulse move is the strong and fast move in the same direction as the trend. So when we have, a trend, we have an impulse move, and then the other type is the pullback. And the pullback, as you can see, are the small counter move against the trend. So we have an impulse move right here. We can write just an I, so you know that this is the impulse move. And then we have the pullback. Then we have another impulse move. Then we have a pullback. Then another impulse move, and so on and so on. So here we have I, and here we have P for pullback. And there are a few very important things you need to learn about the impulse move and pullback. Let me actually delete the colors here so you can see more clearly. Oh, I actually realized that I deleted the drawing as well. Sorry about that. Let me redraw the trend. But here, what I want you guys to see is that within the impulse moves, we often have bigger candles. We have more candles of the same color, and we have something called clear momentum. So within good impulse moves, especially, in this context, we talk about an uptrend. In impulse moves in an uptrend, you will usually see sort of large and many green candles. You will of course find some red candles as well, but the red candles here will often be, smaller, and the overall sort of direction and the overall character of the price movement is that you see many strong green candles towards the upside. While if we look at the pullback, you can see that we will often have very sort of mixed candles. So you will see candlesticks in, different colors, and you will usually have smaller bodies. You will see more wicks. So a pullback might look something more like this. You might have a red candle, pretty small red candle here with a wick. Then you might have, let's say you have a green candle, pretty small candle with a wick right here. Maybe you have a candle that, opens up here, closes up here. Then you might have, a green candle again that looks something like this with wicks. Sometimes you have what is known as a doji candle. So this is basically when we pretty much have no body. You have a candle that looks maybe something like this. This was not a perfect drawing, but I hope you understand that the pullbacks here will have much more sort of wicks. It will have much more sort of mix in candles, and in general the pullback will be not as steep. So many times you will actually see the fundamental pattern look more something like this. You have an impulse move, and then you have a pullback that might look something like this maybe. It's often not as sharp as I showed you guys on the image right here. But here, another thing you need to learn about is that we have two main types of pullbacks as well. First of all, we have the simple pullback, and the simple pullback is when we have a very, one clean counter move. It's very easy to identify. So if we have an impulse move and the pullback looks something like this right here is a simple pullback, but we also have something known as a complex pullback. This is when we have a wrong color. This is when we have an impulse move, and then we have the price doing something like this, and then we have the next impulse move. So this right here is a simple pullback, while this right here is a complex pullback. And both of these can be very good structures to trade, but for beginners, I actually highly recommend to start with the simple pullback, because many traders can easily get fooled to think that the complex pullbacks are actually a trend change. But don't worry, we will learn much more about how to find out mechanically when the trend is about to change, or you can never really say that you are sure of something. You can never be 100% of the price direction in technical analysis. That is, already important to mention. But what we as traders can do, and our goal, is to flip the odds to be in our favor. But here, if you want a note to write down in your notebook that I hope you have up, if not, go get it. Just kidding, you don't have to do that. But the key rule here is that impulse plus pullback equals the basic heartbeat of every trend. If you master this pattern, I would say that, mastering the basics, mastering the fundamentals are so important, and you will be ahead of most traders by just, mastering this concept. Alright, so now let's move on here to chapter 4, and here we will learn about market states. Learning about market states is very, very important because most trading strategies only work in a specific state of the market. So in order for your trading strategy to work, you need to be able to identify what kind of market are we in right now. And here there are actually 3 states of markets, or 4 depending on how you look at it. And let's talk about all the states here. And the very first market state here is the uptrend. And in order to have an uptrend, what we need to have is simply higher highs and higher lows. So you already know what a high and low is. So in order to have an uptrend, when we have, we have one high right here, then we have a higher high. We can write HH for higher high and H for high. Then we have an uptrend. And here we have a low, and here we have a higher low, HL. So as long as we have both higher highs and higher lows, we are in an uptrend. And it is important that we actually have both. So we can't just have, imagine that we have a market where we print, let's say, one high and the price goes like this. You can see here we have higher highs, but we don't have higher lows. So this is actually not an uptrend. This is a sort of range or even a messy market that we will talk more about soon. But uptrends, we need to have higher highs and higher lows. Then we have, the downtrend. This is, of course, the opposite with lower highs and lower lows. But before I show you the downtrend, let me actually show you the range market. This is when lows and highs stay at around the same level. So we might actually continue this market. Let's say we had an uptrend. It might continue even more, but then we might enter a market that looks something like this. And here, it's important that the highs and lows don't have to be at the exact same level, but hopefully you can see that at this point, we have a market where the highs and lows are at around the same level, and this is what is known as a trading range or a range-bound market. However, now let's take a look at the downtrend. The downtrend is the opposite of the uptrend, and this is when we have lower highs and lower lows. So when we are at, when the market has done this, you can see that now we have, one low right here, and then we have a lower low. We have one high right here, and then we have a lower high. So after this high is confirmed, we have a downtrend started, and we will talk soon about how to more specifically and more advanced rules to identify this. But for now, this is all you need to know. However, we do have one more state that you can consider, and this is a transition state. This is when we are in a market that is so messy that we can't really even say if it's an uptrend, downtrend, or sideways market. And in general, the general rule is that when you have a very messy market, try to avoid it completely. Don't trade it, because we have to be honest as traders. There are many times in the markets when the price is almost 100% random. It's very choppy. It's very, hard to trade. And we as traders, what we want to find is the markets that are very clear. For example, we might want to find a super clear uptrend, or a super clear range, or a super clear downtrend. We want to avoid the messy transition period. And here, one important rule I want you to write down is that different market states requires different trading strategies. And I already mentioned this, but you should never force, let's say force a trend trading strategy in a trading range, or never force a, trading range strategy if the market is trending. You need to know what is your strategy, what state is your strategy meant for. But right, so let's move on here to chapter or module 5. And now it's time to take a look at multi-timeframe analysis. And don't worry if this sounds a little bit complicated, because I will, as always, try to break this down in as simple terms as possible. And you will actually realize that this is not as hard as it sounds. And the basic principle here is that big trends contain small trends. In other words, markets are fractal. And fractal is one of these sort of fancy words. You can see the fractal nature here. It's one of these fancy words that the structure and patterns repeats on all scales. So, for example, the same patterns you see on a daily chart also will appear on the 1 hour chart, and will again appear on the 5-minute chart, and so on and so on. And this concept we as traders can actually use to, get better entries and basically, increase our probability of success and making money. And here, when it comes to multi-timeframe analysis, you can either, analyze it on 3 layers. So you can see right here, I have a 3-layer system, but for beginners, I think that 2 timeframes is definitely enough. So you don't have to do all of these timeframes. But the 3-layer system is basically like this. You start with the higher time frame. So this might be, a daily chart or a 4-hour chart. It doesn't have to be that. Day traders sometimes start, maybe on the 1 hour or even the 30 minutes. But the point here is that you always start on the highest time frame. And on the high time frame, you find the sort of overall context and bias. So you determine the overall direction. Are we, bullish in an uptrend, or are we bearish in a downtrend, or are we in a sideways market? So let's once again keep it very simple. Let's say that we are on the we are on the daily time frame, and we have a clear uptrend like this. But now, in order to find better entries, it's often a good idea to zoom in. So we can zoom in a step right here. And on the next step, you can start to find the more sort of structure and levels. Here is when you mark, your key swings, break of structure. We haven't talked about that yet, but we will soon. And zones, and so on and so on. So in this case, we can imagine that this chart right here, let's say that this was actually a weekly chart on our first time frame. And then we zoom in to this part right here. So imagine that we zoom in, and when we zoom in, we realize that this part we zoomed in on actually is an uptrend itself. But now, if you are very advanced, you can zoom in to yet another even lower time frame. And this is where you sort of find the precise price movements. So you find, how to enter and so on and so on. So you might zoom in on this last part right here to take a look at the micro movements. And within this part, you might realize that the price, let's imagine that we zoom in on that part. In this case, that part is probably, it's some sort of downtrend like this, right? And you might want to wait for the price to, for example, break out of this structure. By the way, this kind of structure is something known as a bullish flag. That is a bullish chart pattern indicating a move towards the upside. So you might wait for a break of this pattern. And a common way to enter here is to have your entry point right here. So this right here was the 3-step process. But as I said, for most beginners, I actually recommend to start with 2 time frames. So you have 1 time frame where you identify the sort of main trend, and then you zoom in on the last part of the price to get these better entries. That's actually what I recommend for most beginners. So here I actually a little bit regret what I wrote here. You can see I wrote down that when all three time frames align, your probability of success increases dramatically. And this is very true. But what I do once again want to emphasize that if you have 2 time frames aligned, that is also very good. It increases your probability, and that is enough for most beginners. I think I went overboard with going with 3 layers here. But right, okay, so now let's jump back into TradingView right here. Now, as you can see, I have actually split the chart into 2 time frames. So on the left here, we still are looking at Google. I will try my best to use this chart in as many examples as possible, so you can see that all the concepts works here together. But here on the left, we have it on the daily chart, and here to the right, we have it on the 1-hour chart. And now you might of course wonder, how do I make the split like this in TradingView? And to do that, you go up here to where it says layout setup, and you can press right here, and here you can see you have tons of different options. You can do so many splits. You can actually have up to 16 different splits right here, but that is way overboard. So let's go back here to 2. However, I do think, I'm actually not sure, but I'm not sure if this is possible on the free version. But as I said, guys, I will have a special link to TradingView both in the description as well as the pinned comment. And you can use that link to try out TradingView Premium for free for 30 days. So if you want to follow along here, make sure to use that link and then come back to this video. If not, it might actually be available on the free. You can let me know down in the comments if it's needed or not. But now, let me show you guys a very simple example of this, multi-time frame analysis. So once again, remember on the higher time frame, so on the daily time frame, we'll take a look at what kind of market state we are in. And here we can clearly see we have an impulse move, pullback, impulse move, pullback, impulse move, pullback, right? We're clearly printing, we have one high, we have higher high, we have yet another higher high, we have low, higher low, yet another potential low right here. So in this kind of market, we are in an uptrend. So we are looking to trade in the same direction as the trend. So this is our overall framework. But in order to get better entries, we might actually, or we want to preferably zoom in here to the shorter term time frame. And what you can see here, and this is super awesome, if you zoom in on the last move right here, so zoom in on this part, you can actually see that this part right here is this part on the shorter time frame. And what you will notice is that this is actually a sort of small, a small downtrend, right, on the shorter term time frame. So we as traders can use this shorter term downtrend to find entries. So as I mentioned earlier, one very common way to enter right here is to, you can see we can define this trend by drawing a trend line like this. We also have a lower trend line. One very common and simple way to enter is to wait for the price to break above this downward sloping line. So if we, for example, let's say we get a strong, a strong green candle that closes above this downward sloping line, this would actually be a classic bull flag of, this would actually be a classic entry signal of this bull flag. So a common way to enter this, to do this in TradingView, you go to forecasting and measurement tool, and then you press on long position. If we imagine that this happened, this of course hasn't happened yet. And I also want to mention that even if this happened, it's not certain that this trade will work out. All we can do, as I said, is to try to get the odds in our favor. But the common entry point here would be to enter right here. And then one of the most common places to set your stop loss is to set your stop loss just below the low point within this pattern. So you set the stop loss below right here. I hope you can see it. And then we have many different ways to set our targets. A common way is to use a fixed risk to reward. And for example, if you use a fixed risk to reward of 1.5, our trade would have looked something like this. So if the price goes up all the way here, our trade, we sell our position and we lock in some nice profit. But as I said, this is just one example of how to trade this. Some traders actually specialize, instead of trading the breakout here, some traders specialize to actually trade the sort of touches of the lower bound. So maybe some traders are already within this trade, trying to trade the support structure right here, and since we are on the larger time frame in a clear uptrend, most traders probably expect or the price is biased to actually continue going up. Alright, so now it's time for chapter 6 right here, and now we will talk about Fibonacci and measured moves. These are tools that we can use both to get better entries, but also to find better exits. So this right here is a very important, two very important tools that you really need to learn about. And as you can see right here, these are objective tools for both pullback depth and also profit targets. And let's begin here with the Fibonacci retracement. The Fibonacci retracement is a very popular tool. You might have heard about it, and it is for a good reason. However, I do think that many traders use the Fibonacci completely wrong. As you can see right here, the Fibonacci retracement is used to measure pullback depth, and many traders use it as a tool that sort of magically predict levels, and this is just not true. However, the Fibonacci can still be super useful, because if we align the Fibonacci with other concepts, we can increase our probability of success, and that is all about that is what we as traders, that is our goal as traders. But before we dive a little bit deeper, I want to jump into TradingView and show you guys how the Fibonacci works. Alright, so now we are back here in TradingView. We are still on Google on the daily time frame, and to open up the Fibonacci indicator in TradingView, what you want to do here is that you want to go to the upper left corner where it says GAN and Fibonacci tools. You press right here, and then you can see we have tons of different Fibonacci tools here, but the most common one, and in my opinion this is pretty much the best one, is just the normal Fib retracement. If you want to, you can feel free to start this one so you have it saved, and you can also open it up automatically by clicking Alt F. But now let's just click right here. And to use the Fibonacci, you need to press on 2 points on the chart, and I want to begin by just doing that. So I press right here, and I also press right here. You can see by doing this, you will have multiple sort of lines and numbers appearing here. And in the beginning, this might look very confusing. What does this number, 0.382, 0.236, what does this even mean? Well, it's actually not that hard. And let me show you. So first of all, you might wonder, what does these numbers even mean? Well, 0 just means 0, and 0.236 means 23.6%. 0.382 means 38.2%, and so on and so on. But what does these percentages actually measure? Well, they measure pullback depth. So if we have an impulse move, imagine that this is an impulse move, what these numbers measures is how far are we pulling back compared to the original move. So if the price pulls back to this line right here, it means that we pulled back, as you can see, 38.2%, right? And if the price pull backs even deeper, let's say we pull back all the way down here, then we see that the price pulled back to 0.618, which means 61.8%, right? And this is the basics of the Fibonacci. It's not harder than this. But there are a few rules here of Fibonacci. The first rule is that most pullbacks will end in this area right here. It will end in the 0.382 to 0.618. This is what is known as the golden zone. We will talk a little bit more about that soon. However, in very strong trends, the pullbacks tend to end in this area right here, 0.236 to 0.382. And this trend right here, the chart we're looking at, the Google chart, this is actually a very steep trend. So many of these pullbacks will probably end in that area. But now, how do we draw out the Fibonacci? Well, to draw out the Fibonacci, I first want to mark up the structure. This is a good rule of thumb to do. So let me actually close this one. And let's mark up the structure. We have an impulse move, pullback, impulse move, pullback, impulse move, pullback. And to draw the Fibonacci in an uptrend, you want to start at the swing low, and then you draw it up here to the swing high. And as you can see, in this case, the price pulled back. It pulled back all the way almost down here to the golden zone. This right here is the golden zone, but it pulled back and pretty touched the 0.382 before the next impulsive move. And if we want to draw out the next Fibonacci, we just repeat this process. We draw it from this swing low to all the way up to the swing high. And you can see in this case, the pullback is a little bit more shallow. But remember here that it's not certain that this pullback is done. Actually, we don't really confirm the continuation of the uptrend until we actually break this point right here. And this is something I will talk about more soon. But alright, so now when you know the very basics of the Fibonacci retracement, one thing you can write down right here is that the golden zone is the zone here between the 38% to 62%. And this is the zone where most healthy pullback retrace to. But as I said, this is not a rule that says that every pullback will retrace to that area. As I already mentioned, in strong trends, we actually tend to retrace more shallow to the zone above it. But as a rule of thumb, when we enter this zone, this is a good zone to look out for, the beginning of the next impulsive move. But here we also have a concept known as measured move. And what we mean by this is that the next impulse often equals the size of the previous one. And we can use this to create targets. So what do I mean by this? Well, if we have an impulse move right here, and then we have a pullback, the next impulse move, it's pretty common that this one is around the same length as the first one. So if we measure this length right here, we copy that exact length and then we draw it up right here. Now I don't have enough space, but I hope you can see the point here. Many times the next impulse move will be the same length as this one. And this is, once again, it's definitely not a perfect rule, but this is just more of a rule of thumb. And many traders will actually use this measured move as their target levels, just because the measured move, the next impulse tend to be the same length as the measured move. And what are the benefits of this? Well, a main benefit of these concepts is, of course, that we get objectivity. So markets are very random. So we as traders, we want to find rules that we can stick to no matter what. So the measured move gives us a tool for objective measured targets. No more guessing when to lock in profit. But once again, it is important to emphasize that these are guidelines and they are not perfect rules that work all the time. And of course, the Fibonacci and the measured move, you always want to combine with the other market structure concepts we talked about earlier in the course and that we will talk about in the future. Never do the mistake that many beginners do and only use Fibonacci, because you will, I have to be honest, you will probably most likely lose a lot of money over time doing that. Alright guys, so now it's time to move on to some a little bit more advanced concepts, but as always, I will try my very best to break this down in super simple step-by-step manner. Now we will talk about three things called BOS, CHOCH, and MSS. And these are basically 3 signals that can keep your trend reading more objective and more mechanical. You know, this is one of the main problems with beginner traders and basically with technical analysis in general, that it's so hard to get objective rules for if we are in an uptrend, if we are in a downtrend, and so on and so on. You know, 2 traders can look at the same chart and reach different conclusions, and these are basically concepts that can help us make this more rules based. However, even when it comes to these concepts, different traders have some slightly different variations. But let's take a look at these concepts now step by step. So first of all, we have the BOS, and this basically stands for break of structure, and it signals that the trend is continuing. And a break of structure is when the price breaks the previous swing point in the trend direction. And this basically confirms that the trend is continuing and that the trend is still intact. So let me actually right away try to demonstrate this. So if we have an uptrend like this, the break of structure is when we break the swing high of the trend. So for example, when the price pushes above this point right here, this right here is a break of structure. And also you can see when the price pushed above this high right here, here we have a high, when we pushed above, so at this point right here, we have a break of structure. So this is very simple. But what can make this much more complicated is that in real life, in real markets, you will often not see the perfect trends like this. Most of the times the price will actually move something like this, and maybe something like that. But the important part here is that as long as the price is holding the low of the trend, remember here, in order to have an uptrend, we need to print both higher highs and higher lows. So as long as we're holding this purple line right here, we are still in an uptrend. So you can see that if you look at this chart right here, where is the next break of structure? Well, the next break of structure is, of course, once again, when we break the high of the trend and we push above that high. So the next break of structure is up here. But here comes the point of the change of character. So here, the change of character, or for short CHOCH, is basically the first indication that we have a trend change. A change of character can indicate either a change from an uptrend to a downtrend, but it can also indicate that we're changing the trend state from an uptrend to a sideways market. And of course, the same principles apply for the downtrend as well. As I said, this is the first meaningful break against the established trend, and it indicates that something is changing. And here, the change of character happens when the price breaks. If the price, pushes like this and breaks below, you can see when we break below the last low here in the trend. So this right here is a change of character. And if we have a downtrend, the same principles apply. If you want to, you can pause the video and try to find the break of structure and change of character in this trend yourself. Did you find them? Well, right here, if you look right here, this is the first break of structure, because this is the point where the price breaks to a new low. This right here is the next break of structure, right? Because here the price once again breaks to a new low. But here we can clearly see that the price fails to maintain the, in this case, the high. So here we have a change of character. And then right here, we once again have a break of structure. And this break of structure is especially important because this is the first break of structure. And this is the, in the new uptrend. And this is the break of structure that will cause right here that we have one low and a higher low and one high. And you can see that no matter where this move ends, we will have a higher high. So if it ends right here, we will have a higher high. If it go even higher, we will still have a higher high. So this break of structure is important. So, if you just learn this simple principle of break of structure and change of character, I would say you have a better grasp of market structure than most traders. But here we have yet another concept that you might have heard, and this is something called a market structure shift. And when it comes to this is actually a problem with trading terminology, because a market structure shift, most traders, as far as I know from my research, they use it as the same term as change of character. So for most people, this is the same thing as a change of character. As you can see, most traders define market structure shift the same as change of character. But as I said, there are a lot of confusing and conflicting info. I have been trying my best to research this, and that is why I highly recommend that we stick to break of structure and change of characters. These terms are clearly defined, but I thought it was important to include this, that if you hear about market structure shift, they are probably talking about this, right? They are probably talking about the change of character. But for this course, try to ignore market structure shift and focus on change of character and break of structure. So if you want to write something down, you can write down this quick reference right here. Break of structure indicates continuation, and many trading strategies actually needs break of structure. So if you're trading in the same direction as the trend, it's very important to be able to identify. And the change of character is the early warning, the indication that we are starting to see the trend change. However, remember that a change of character is no guarantee that the trend is changing. In order to actually confirm a complete trend change, we need a break of structure after the change of character. So here you can also write down the key takeaway. BOS and change of character are all you need. These two signals will keep your your reading very simple and clear. And now at this point, you probably already have a break of structure and change of character locked in, but I thought it would be good to just show this on the same chart we have been using throughout the course. So, once again, we have the impulsive move, we have the pullback, we have the impulsive move, we have the pullback, we have the impulsive move, we have the pullback. Can you find the break of structures? Well, right here we have a BOS. Right here we have another BOS. And where does the price need to go in order for us to have a change of character? Well, the price actually needs to drop all the way below this point right here, right? In order for us to actually have a change of character. So Google is right now in a very strong uptrend, even though we have been seeing this, this pullback recently. All right, so let's move on here. Now you need to learn about two more very important concepts, and that is strong and weak levels. And here we have learned about highs and lows, but it's important to notice that not all highs and lows are created equal, because some highs are much more significant than others. And in order to know which high to pay extra attention to and which low to pay extra attention to, we need to know about strong and weak levels. And first of all, what is a strong level? Well, a strong level is simply a level that caused a successful break of structure. And these strong levels are more likely to hold as support, when the levels are retested. And the opposite is true here for a weak level. A weak level is a level that failed to break structure, or I can also include here, failed to cause a change of character. And these are levels that are more likely to get taken out. So let's continue here with our uptrend example. So once again, we have this clear and easy uptrend. And to make this simple, we can once again mark out our break of structures. So we have a BOS right here, and we have a BOS right here. And to identify the strong levels, we need to look at the start of the move that breaks structure. So for example, if we look at this break of structure right here, you can see that right here is where we broke structure, but the start of this move is actually at this point right here. This is the sort of origin of the move. So this red point right here is actually the strong level. And in this case, since it's a low, we call it a strong low. And the same thing is true for this point right here. This is the start of the move that broke structure. So this right here is another strong low. But what about the weak levels? Well, as I said, the weak levels are levels that failed to break structure or failed to change character. So for example, if we take a look at this point right here, this right here is actually a weak high. Why is this a weak high? Well, because the move that started from this point, so this whole move right here, failed to change the character of the trend. So let's actually continue this trend like this. In order for this high to be a strong high, the price actually needed to push all the way down here below this point. If that move pushed below this low right here, it would have been what? Well, it would have been a change of character, which made this high, which would have made this high strong. The same thing is true right here. So this right here is a weak high because it failed to cause a change of character. But if the trend now does this, and breaks below the strong low right here and causes a change of character, now is this right here a strong or weak high? Well, this right here would now be a strong high. And knowing if a high or low is strong or weak is important for so many reasons. Here are just some examples. If we have a strong low, as I said, it tends to hold. So this can be a good place for stop losses. It can also be a good place for entries. If the price comes down to a strong low, we can actually look to trade the bounce of that low. And there are so many more strategies we can trade around this. And also looking at weak levels is very important because they often get taken out. So we can watch for continuation and perhaps trade, breakouts of these trades and so on and so on. Many trend continuation trading strategies can greatly benefit from understanding if a high or low is strong or weak. All right, so now let's take a look at some of the best ways to enter the market, or in other words, let's take a look at some entry models. And here I have two models, Model A and Model B. And let's start here with Model A. And this one is called the pullback entry. So what we're looking out for here is that we're looking out for a strong impulsive move. We wait for a pullback, and then we join the next impulsive move towards the upside. So first of all, in order to have a good pullback, we first need to have an uptrend. And you hopefully know how to identify uptrends. Well, in order to have an uptrend, we need to make higher highs and higher lows, and we need to have break of structures. So for example, right here, we have a break of structure. Right here, we have another break of structure. So let's say we are at this point in the chart, and now the price starts to pull back. So a common way for the price to pull back is that it looks maybe something like this. What we as traders usually do is that we define this pullback. So we usually draw a line trying to define the resistances within the pullback, and then we draw a support line as well. And the first way to enter here is what is called the aggressive entry. And this is where you try to enter at the support level during the pullback. So this is when you try to enter basically at the support right here. But when it comes to entry points in general, the exact entry points are actually a little bit more about price action. Remember, price action is when we zoom in here to the details, and market structure is when we zoom out. So I can already mention that I highly recommend you guys to check out my full course on price action. I'll make sure to link that course in the video card and the description. So you can already save that course to a watch later playlist. But what you want to look out for here, preferably at the support level of the pullback, is some kind of bullish signal. So you can either look out for perhaps a candlestick pattern. So let's say we get a hammer pattern here at the support. That is a very good signal. Or another thing you might see is just a strong momentum candle, so a strong green candle. But you want something that shows that the bulls take control of this support, because that makes it much more easy for us to also set our stop loss and target and so on and so on. So let's say that we have a hammer pattern right here. A hammer pattern is basically a pattern that looks something like this. If we enter on this hammer, our entry would be at the candle close of the hammer, and the most common way to set your stop loss is to set your stop loss just below the hammer. So this right here would be our entry, and our goal with this pattern is, because we are in an uptrend, we expect the trend to continue. We expect to eventually see another break of structure and for the trend to continue up here. So that is the first way to enter. The second way to enter here is to actually wait for the break instead. So you can see here a bit more, you can call it more conservative entry, is to wait for the breakout of the pullback structure. So we can, instead of entering at support, we can wait for the break right here. And once again, when we see the break, we don't want to see, preferably we don't want to see, small and weak candles on the break right here. We preferably want to see a strong bullish candle, what is known as a momentum candle. And we haven't talked about this, but what I also really like to see on breakouts is that we see lots of volume. So we can add a volume indicator on the chart. Lots of volume basically means that we have lots of market participants participating in the move, and that makes the move more significant, and it makes it more likely that the trend will continue up here. And when we do this kind of entry, we usually set the stop loss below the low of the pullback. And when it comes to target levels, we can either use a measured move. A measured move is when we basically measure the impulse move right here. We take this exact measurement and we start measuring from the low of the pullback. Now I don't have space to write it, but imagine that you copy the exact length of the orange arrow and you start it at the low of the pullback, and then your target level will be right there. And the other way is to use a fixed risk to reward. Let me actually try to show this. Let's say we have a line with entry right here, and we have a stop loss right here. A fixed risk to reward is basically when you measure the length to the stop loss, and then you use this length to take your target. So let me try to demonstrate this. So for example, a fixed risk to reward of 1 means that the length is the exact same. So the length to the stop loss and to the target is the same. So this right here is a 1-to-1 risk to reward. A 2-to-1 is that the target is, 2 times as long as down to the support. A 3 risk to reward is 3 times, and so on and so on. I hope this is clear. This demonstration is clear. But this is yet another way to take your targets and lock in profit. But alright, so now let's take a look at model B. And this entry model is something called the failure test, or it has many other names. Some people call it the 2B pattern. It's also known as the Wyckoff spring or Wyckoff upthrust. But the name is not really important. You can call it whatever you want. The important part is that you actually learn about the pattern. So what this entry point is, it's basically when the price breaks a level briefly and then snaps back. So it's basically a trap for other traders. And here, the entry is actually when the price recloses inside the range. So let me once again demonstrate this with an uptrend. So we have an uptrend right here. We have the other move, and then we once again have a pullback. So in this case, we might have a pullback that looks something like this. And we can once again define the pullback with a resistance and a support level. A failure test is when the price comes down here to the support and then briefly break the level and then snap above. So a very good pattern to see on a failure test is once again the hammer. So we might have a hammer that, as you can see, snaps below the support, and then before this candle closes, the price is once again within the range. So you can see the hammer goes below the support. It takes out many people's stop losses, which creates liquidity for often smart money to step in and push the price up again. So this right here could be a great entry because we are in an uptrend. We expect the trend to continue. So we can enter at the candle close. We can have our stop loss below the low, and we can use, for example, a fixed risk to reward to get our target level maybe somewhere up here, right? But here, the failure test pattern we can also use for counter trend moves. So let me actually delete this part of the trend, and let's imagine that instead of this uptrend actually breaking structure. So remember, in order to break structure, we need to push above this point right here. But maybe instead of breaking, we might see the price failing to break this structure. And if we also at this point see a strong, strong candlestick pattern where the price briefly push above the resistance and then pushes below, this can actually be a case where we can enter a trade in the opposite direction. And how good this trade will be will depend on other things like how is the overall market context. So have we been in a long and strong uptrend? We can also use indicators to improve our rate of success. But this is the general principle. In this case, when you trade this, you want to enter a short trade. This is where you bet that the market will go down. You make money when the market go down. So here you enter at the candle close. Now your stop loss will of course be above the pattern. This is very important for the failure test. Many entry models have much of subjectivity where you place your stop loss, but for the failure test, the stop loss is pretty much always set above or below the extreme of the pattern that briefly pushed above and then closed within. So your stop would be above that point, your entry right there. And let's say you use a fixed risk to reward, then maybe your target is down here using a risk to reward of say 2-to-1. So here, if you once again focus on the text, you can see that the stop loss, we place it past the wick of the failure. And you might wonder, why is this a strong entry? Well, one of the reasons it works is that failed breakouts will trap traders on the wrong side. So, for example, if you look at our example we have on the screen, when the price breaks above, briefly breaks above here, so many traders would think that we are creating a break of structure and that the trend will continue. So many traders will enter a long position on the breakout. But when the price eventually, goes in the opposite direction, it means that many traders will be trapped in a long position, and as the price goes down further, they will eventually hit their stop loss, which leads to more selling, which can lead to even more traders stop getting hit. So this actually helps us create this selling pressure to the downside. And the opposite is of course true if we have a bullish trade. Alright, so now let's switch the attention to a concept that can make your chart reading much clearer, but only if you use it correctly, and that is trend lines and trend channels. This is actually one of these concepts that I think it really depends on how you use it, because many beginner traders are really drawn to drawing, trend lines and trend channels all over their chart, but they are mostly done wrong. Especially for beginners, so make sure to really pay attention. But first of all, what is trend lines and trend channels? Well, when it comes to market structure, we don't just have horizontal levels. So far, we have been talking mostly about horizontal levels, break of structures, change of characters, weak and strong highs, and so on and so on. But trend lines and trend channels are basically levels that are sloped. So here, market structure isn't just horizontal, it can also be angled, and this is what trend lines show. Trend lines basically show higher time frame, pressure, and rhythm. So we can have a rising trend line, which is basically when we connect higher lows in an uptrend, and we can have a falling trend line, which connects lower highs in a downtrend. So when we have an uptrend, like right here, you want to draw your trend line here by connecting the lows, and if we have a downtrend, you want to draw your trend line here by connecting the highs. And here I actually realized a mistake. On this warning sign right here, I wrote failing to reach a trend line more so of a weakening strength, and this is of course wrong. I mean failing to hold a trend line can warn of strength here. Let me redraw this image right here so I can just show the concept. So let's draw out a clear uptrend right here. I try to draw it pretty symmetrical so we can show this concept. And then we draw our trend line support, something like this. So here, one thing that a trend line can help us with is to understand if the character of the trend is changing. So for example, if the price now goes down here and breaks below the trend line, so we break below right here, this means that the symmetrical nature of the trend is changing, right? Because in a perfect uptrend, we often want the swings here to be around the same. So we want, preferably, this swing to be around the same size as this one, around the same size as this one. But when we break the trend line, we are noticing that something is changing about the trend. But here is a big mistake that many beginners make. And that is to think that the trend is, over when we break this point right here. And as you know, if we use the break of structure and change of character concepts, we are not changing the trend until we break this point right here. So if you use trend lines, you want to use them as information about that something is changing about the trend, but not necessarily that a break of a trend line means that we're automatically shifting from an uptrend to a downtrend. That is a big mistake, and that is not the way to use trend lines. It's much better to use them as information that something is changing, but not necessarily that you should trade based purely on trend lines. I actually strongly recommend against that. But one thing you can use is actually the principle that many beginner traders will use these trend lines, so you can actually take advantage of that, and I will talk about that soon. But before we do that, I do want to switch the attention and take a look at another thing that is very useful, and that is trend channels. So a trend channel is basically parallel trend lines. So this is when we take, the exact slope of a line and we copy it and we place it at the top. So in this case, in this uptrend, let me delete some stuff to make it more clear. We can take this exact slope of the orange line and we can draw it here at the top. And here I actually remade the image to make this a little bit more clear, but hopefully you can see here we have the trend line. Let me actually draw this one so this one touches up here like that. Here you can see we have a clear trend channel, and one of the main ways to use a trend channel is that you can use it as a sort of measured move, or you can use it as a structure that if the trend continues the way it has done, you would expect that, you know, when we see the break of structure right here, so when the price breaks above this point, in order for this trend to continue being symmetrical, the price should push up here to around the trend line, right? The top of the trend channel. So this is a way you can use trend channels, that when the price reaches at the top of a channel, that is usually, you know, around the level where where we expect the price to reverse. But once again, don't use. I highly recommend to never use trend lines and trend channels as, you know, as super clear and strict rules. These are just, you know, general concepts that can be, you know, a nice little spice to your analysis. It's not the sort of bread and butter, if that makes sense. Another concept is that, of course, if the price pushes above here, so if we push even higher, what does that indicate? Well, this indicates that the trend is now shifting to become even stronger. The slope is starting to get even higher. So that might mean that we need to shift our how we use our Fibonacci tool, and that might shift how much risk we are willing to take, and so on and so on. Alright, so now let's move on here to chapter 11, and this is the fractal dimension and regimes. And don't worry about the fancy name. What this chapter is all about is, you know, the different characters of the market and which markets we should look for and which markets we should avoid. So here, you know, smooth versus choppy markets, adapt or get chopped. You will soon mean what chopped means. But first of all, I want to take a look at two of the sort of main market personalities. The first personality, and this is a market we really want to look for, is a smooth market. And don't worry, I will soon show an example of this. But this is basically when we have a market that, in simple terms, has easier structure to read. And what I mean by this is that we have long and clear impulsive moves, we have cleaner pullbacks, we have clear break of structure and change of character, and so on and so on. So once again, this is a market, you know, in real markets it will never be perfect, but this is a market that perhaps looks something like this in an uptrend, and the opposite, of course, in a downtrend. But the other market, and this is a market we really want to avoid, is what is known as a choppy market. This right here is when a market is very difficult to read. Oops, wrong color right there. But it's difficult to read and it has noisy conditions. So it might have, you know, overlapping swings, many fake signals, trap traders everywhere. So this is more when we have a market that, you know, looks very much like this. You know, it pretty much is random price movements. And this is an important principle that you really need to have in mind, you know, as a trader. And that is that markets are actually pretty random most of the time. Our job as traders is to find the moments and the conditions in market when they behave in a more predictive manner. And this mindset can really help you to stop, you know, over-forcing trades. That is a very common mistake with beginners, that they try to force a trade in every market condition. Trading is actually much more about waiting. You wait and wait and wait for the perfect conditions, and that is when you trade. So the dangers here of these kind of shopping markets are that you will see many false signals. You will see fake break of structures and change of characters everywhere that are not significant. If you try to trade these markets, you will notice that your stop losses will get hit all the time, and the structure seems to change every few candles. It can be hard to even, see what kind of structure we are in. So here, and you want to write this down, your job as a trader is to notice the regime or notice the condition we are in and adjust expectations and risk. And as I said, in shopping markets, I wouldn't even say that you should reduce size and so on and so on. Simply waiting is often the most logical and best option here. So now let's jump back here into TradingView because now we are once again looking here at the Google chart. And as you guys probably know at this point, this chart is actually a very good looking clean chart. Why? Well, because we have, these clear impulsive moves, pullback, impulsive move, pullback, impulsive move, pullback. This is exactly the kind of chart we're looking out for when we trade. But here, one principle you can also notice is that let's actually change the time frame. So to do that in TradingView, you click on the number right here. And as you can see, you can have all the way from daily time frames to minute time frames to even seconds. So you can look at second chart here. This might be, I think seconds, maybe it's not available on the free plan. You might need essential or even premium for that. But as I mentioned earlier, I do have a link to TradingView. It will be both in the pinned comment as well as the description. And you can use that to try out TradingView Premium for free for 30 days. So you can get the most out of TradingView for free and try it out. But let's actually change this market to a 1 minute time frame, because on the lower time frames, the markets in general tend to be more choppy. So let's zoom in here on the 1 minute time frame. And as you can see right here, recently, the recent moves right here is actually relatively clean. You can see we have these sort of swings towards the downside. We have a very steep pullback. We have another swing. Now we are pulling back once again. But if you look a little bit to the left and you look at, this part right here, this right here, I would say is a good example of a choppy market. You can see that during this period of time, you have, the candles going up and down in a very messy manner. Here it spikes up for a bit. And some traders might think, oh, this is the trend change. But nope, we go once again back in the range. We go here, we shop, you hopefully can see that this is a market that is very hard to trade. It's easy to get burned, and it's hard to know, where should I even place my stop loss? Where should I even enter? And so on and so on. So this is a good example of a choppy market, while this part right here is much cleaner. But this is still far from as clean as, the daily time frame right here, which is currently looking, much, much better. So if you are focusing on trading uptrends, these are the kind of trends that you want to look out for. All right, so if you made it this far in the course, you are already ahead of, pretty much all beginners. You have come a long way. You know how to read price, you know how to spot trends, you know how to find key support and resistance levels, and you basically have a good understanding of both price action and market structure. But I'm sorry guys, but I have to give you a reality check. The big players, or in other words, smart money, think about the banks, hedge funds, and basically, traders with lots and lots of money. They are also looking at the same levels, and they can actually use these levels against you. And if you want to prevent that from happening and, really start making money, what you want to do is that you want to learn how to look inside the candlesticks and take a look at what is actually happening when a candlestick is formed. And this is where order flow comes in. The final part of this course will be all about order flow, and this is where we learn about concepts like, what is an order book. We will learn about volume footprint charts. We will learn about volume profile and many other instruments that basically are used as an X-ray for the candlesticks. We get a much deeper understanding of orders and also how smart money is trading. This right here is some more advanced stuff, so make sure to really lock in before this section. Grab another coffee, make sure you have your notebook, because now we're about to lock in to the final part of the course. But okay, so before we can start making money with order flow, we of course first need to know what is order flow trading in the first place. And in very simple terms, order flow show you how candlesticks are actually formed. So you can basically look inside a candlestick and take a look at, it's like a more detailed view of a candle. So you can see here, it reveals what happens inside each candles. It reveals the battle between buyers and sellers. Traditional charts only show the results. So if you have a normal candle, you only show, the price result of that candle. But with order flow, we can dive even deeper and show the cause. Why did the candle form? And if we can understand why the candle formed, we can, as a result, make better trading decisions and, hopefully, as a result of that, make more money. So here, by studying order flow, we can see who controls the market and understand why price moves. It's super important if you want to improve as a trader to understand the reason behind price movements. So one analogy is like it's like giving our chart an X-ray and show the real activity behind each bar. And now let's super quickly jump into TradingView here. I just want to give a little sneak peek on, how the chart will look like after this course. And you might look at this chart and think that this sounds super complicated, but I promise you, if you watch this full course, you will understand exactly what's going on this chart right now. You will be able to read it. But to do that, you really need to pay attention to this course. I can also just mention right away that the charting platform I use for all my technical analysis and the charting platform I will be using in this course is TradingView. And if you want to follow along and use all of the tools I use in this video, I think you might need TradingView Premium. But don't worry, because I do have a special link that you can use to try out TradingView Premium for free for 30 days. And if you, after the trial period, decide that you want to continue using it, you will get a $15 bonus. So I recommend to use that link if you want to follow along with exactly everything I do. But if not, don't worry, you can use the free version of TradingView as well and follow along with most things. But right, so now let's switch attention to take a look at something super important, and that is how buyers and sellers set the price. Or in other words, how are the buyers and sellers creating the candlesticks you see on the chart? Well, you can think about all markets, whether it's crypto, stocks, or Forex, like auctions, where buyers and sellers are constantly negotiating for prices. In simple terms, buyers always want to buy as cheap as possible, and sellers want to sell as high as possible. This is very logical. If you want to buy something, whether it's, a crypto or maybe it's, food, you always prefer to buy lower. And if you sell something, you always prefer to sell higher. And the price here, where both sides meet, the buyers and sellers meet, are known as fair value. And fair value is something you can write down in your notebook. This is something that will come up again and again during this course. It is a very important concept. And here, when both sides agree for a while, so when they agree during a long period, the price tends to move sideways and you will see volume build up. This is what is called a balanced market. And when we, for some reason, have one side becoming stronger, this is what is known as an imbalanced market. So here you can see a simple example of a balanced market and an imbalanced market. Remember, a balanced market is a period of time when prices are roughly the same. So for example, if you look at this period right here, this right here is a balanced market. And in balanced market, you will often find trading ranges or consolidations. This is basically all kinds of movements when we have the price going roughly sideways. But then we also have periods like right here. This right here is an imbalanced market. This can be, sharp moves or trends to the upside or sharp moves or trends to the downside. And these markets are very important to be able to spot as traders, because in these markets, we can make lots of money. These are usually the kind of move we are trying to catch, because trading within, trading within balanced markets like right here is often, much harder than, trading and riding the waves of imbalanced markets. And one more thing that can be a little bit hard to understand in the beginning is that, you might wonder, okay, so what is the fair value? Well, the fair value of this market is all of the prices. So when we are right here, this right here is the fair value, because this right here was the moment where buyers and sellers agree and a transaction took place. So it doesn't matter where we are in the market, if we are in a balanced or imbalanced markets, all of these red dots here are fair value, are the fair value. But as I said, don't worry if this sounds complicated right now. It will get more and more clear throughout the course. The rest of the course, these two ideas are, first of all, something known as the value area. This right here is the range where about 70% of the trading took place. And this 70% basically comes from, in simple terms, it comes from one standard deviation in statistics. You don't really have to worry about where this comes from, but this is a very common percentage that traders use, and you will learn all about it. The next important concept we need to learn about is something known as POC, or for short, or for long, I mean point of control. The point of control is the exact price level where the most volume got traded. So it's showing the market's we can call it fair price. It's not really the same as fair value as we talked about earlier, but point of control is the level where most volume took place. Okay, so to understand value area and point of control, I want you to look at this image right here. You can see the black line right here. Imagine that the black line is a price movement, and here the value area, remember the value area is where 70% of the trading took place. So in this case, the value area is this yellow area right here. We can call this area the VA. And you can see that this tool we have right here is something known as the volume profile, and you will learn about it later on in this course. But you can see that the taller the bar are, the more volume got traded. So for example, right here, very little volume got traded, while for example, right here, tons and tons of volume got traded. And the value area, so the area between, this point right here and this point right here, you can hopefully see that on this chart, this was the area where indeed pretty much all price movement happened. You can see only very little price movement happened outside of this area, and this is why this is known as the value area. But then we also have the point of control. And remember, the point of control is the exact level with the most volume traded. And in this case, we can see that the most volume traded was this bar right here. The tallest bar is the most volume traded. And so this right here is our point of control. And you can hopefully see on this chart that it does make sense that this was the point of control, because this one touched the price touched right here, right here, right here. You can see lots of trading has been taking place on this price level. And the concept of value area and volume, the value area and point of control can not only be applied to the volume profile, which we're talking about here. You can actually use these concepts when you look inside candles as well. And that is one big reason why I wanted to talk about the value area and point of control already this early in the course. But alright, so now it's finally time to start diving deeper and take a look at how trading works behind the scenes. So now we will start learning about how the candles are formed. And first of all, what we really need to learn about is the different order types in the market, because every candle you see on the chart is created by orders being filled and matched. So all of the candles are created by either, players jumping into the market and buying or selling, or they can also be created by, for example, stop loss orders, where, sellers, like for example you and me, place an order that, if the price goes down to a certain price, we will automatically sell, or if the price goes up to a certain price, we will automatically buy. These kind of orders also are very important. So now let's take a quick moment and learn about all orders. And don't worry, I will show you guys a visual explanation of this very soon. But first of all, we need to know what the different orders are called. The first order is the most simple one. This one is known as the market order, and this one gets filled immediately at the current price. So if you, for example, place a buy market order, that means that I want to buy, let's say, Bitcoin. If you place a market order on Bitcoin, it means I want to buy Bitcoin right now for the current price. Or if you place a sell market order, it means I want to sell Bitcoin right now for the current price. Then we also have a limit order, and a limit order is filled at a better price. And remember, as buyers, we want to always prefer to buy at cheaper prices. So buy limit orders are placed below the price, sell limit orders are placed above the price. The stop order is the opposite. This one is filled at a worse price after it gets triggered. So for example, stop sell order is triggered below the price, and this is worse because you always want to sell high. But as I said, this is a bit hard to understand if you don't have a visual, so I will show a visual very, very soon. But two important things you need to know about market orders and limit orders is that market orders moves the price. The market orders moves the price because they take liquidity that is in the book. Limit orders, on the other hand, add liquidity because they are placed in the market and they will wait there until the price moves there. So for example, if Bitcoin is right now trading at, let's say that Bitcoin is trading at 100,000 and you place a limit order at 90,000, this one will not affect the market right now until the price actually goes down to 90,000. And here, a very important principle: every trade happens because one trader buys and one trader sells. This is very important to have in mind, but it's still very different if you are, buying because of a limit order or a market order. All right, so now let's take a look at the different trading order types. And this right here is super important for the rest of the course, so make sure to really pay attention. And I hope this visual will really help. And let's begin here by taking a look at the long position. By the way, if you don't know, long here means when you long something, it means that you bet that the market will go up. So you want the market to go up. And if you short something, this is the opposite. This is when you want the market to go down. You make money when the market goes down. By the way, if you want to learn how shorting works, I do have a video about that. I will make sure to link the video in the video card so you can watch it after this course. But for now, when it comes to going long, remember here that the limit order is always at a better price. So your sell limit, because you always want to sell for as much as possible, you can see that the sell limit is above the price where you go long. So this is the case where you go long at market. You place a market order. Let's say that you place a market order and buy Bitcoin right now at 100,000. The sell limit is always at a better price. So maybe you set the sell limit at 110,000. And also remember that the sell stop, the stop order is always at a worse price. So maybe you set your stop loss here at 95,000. So always have this in mind. The limit is better, the stop is worse. The limit is better, the stop is worse. But how does it work when you go short? Well, let's say that you go short here at Bitcoin at, let's say this is 110,000. Remember here that the stop loss is always at a worse price. And when you go short, the price is worse when it's higher, because remember, when you go short, you want the price to go down. So let's say that you go short at 110,000, then your stop might be at 115,000. And your buy limit might be at around 90,000, because remember, the limit order is always at a better price. And when you short, you want the price to go lower. So in other words, in both of these cases, you can think about the limit order as a target, right? Because if you buy at 100,000, you can have a target at 110,000. And in the short example, you can also think this as the target, because you want the price to go down, and if it goes down, you make money. And also in both of these cases, you can think about the the stop order as the stop loss. In the case of a long position, your stop loss will be when the price goes down, but in the case of a short position, your stop loss will be if the price goes up. I really hope this visual and explanation helped you guys understand the different order types. But alright, so now it's finally time to take a look at the order book and the market depth. And as you hear in the name of this course, it's called order flow trading. You already hear on the name that the order book is very important, and you're not wrong, the order book is super important here. So let's lock in and pay attention. But to begin here, what is the order book? Well, the order book is basically a list of all pending limit orders waiting to be filled. And remember here, limit orders are orders we place in the market. They don't get executed right away. They will sit there and wait. And that is why they get placed in this book. And the left side of the order book shows buy limits. So this is, buy limit orders. And the right side show sell limits. The buy orders tend to be green. The sell orders tend to be red. And don't worry, I will show you guys a visual very soon. But here, and this is important, the order book can actually be pretty hard to read. But there is something called depth of market, or for short DOM, which is a more simple version of the order book. The depth of market uses, clear colored bars to show how many orders that exist at each price. So the more orders we have, the longer the bar will be. And it's very, as I said, visually appealing and easy to learn. And I will show you this very soon. And here we have two important concepts. First of all, we have something known as a deep market. A deep market is, in simple terms, when we have lots of orders in the order book, and this can make the market more stable, because in order to move the price, we need to eat all of the limit orders. And the opposite of a deep market is a shallow market. This is when we have fewer orders, and because we have fewer orders, a large player can move the market very easily. So this means larger and quicker moves. And here, and this is very key, the price rises when aggressive buyers clear the sell orders, because this is the only way for the price to move. Or the opposite can of course also be true. If aggressive sellers clears the buy limit orders, the market also moves. But now let's jump in and take a look at order book and depth of market. But right, so now let's take a look at the depth of market, or for short DOM. And you can actually think about the depth of market as the same thing as an order book. The only difference here is that the depth of market is easier to read, because in the depth of market, or DOM, the length of the bars, so for example, if you take a look at the sell side, the length of the bar will correspond to how many sell limit orders that are in the market. So let's go over this in a step-by-step manner. So first of all, we have two sides. The green side here is known as the bid side, and this is where the buy limit orders are placed. So you can think about bid as buy limit orders, and the ask side is the sell limit orders. And what you also can see here is that you have the price here in the middle. So let's say that this is a stock. It right now trades at around 100, and you can see here at the price of 105, we have 85 sell limit orders. So 85 orders are waiting at that price level, and here at 104 we have 72 orders waiting, 103, 68, and so on and so on. And the same thing, but the opposite is true on the green side, the buy limit side. So for example, if we take a look at the price of 99, we have 24 orders waiting. At the price of 96, we have an order to buy 92 waiting. And let me actually be more specific. The numbers here are not how many orders or how many people that want to buy. The numbers are how many stocks or how large the total orders are. So this is, you add up all the orders. So for example, this 92 side might be, 3 orders in total. One that wants to buy 90 plus one that just want to buy 1 and another one that wants to buy 1. So it can be just 3 orders, but the orders should add up to 90. I hope I'm clear here. But now the next very important concept I want to talk about is the concept we talked about with deep and shallow markets. So remember here, a deep market is a market where we have lots of orders. So for example, if we take a look at this part right here, we can see that this part is much deeper, right? So this part is pretty deep compared to, for example, this part right here, which is much more shallow. And remember, we call it deep and shallow because if someone wants to move this price and push the price up to, for example, 103, it's pretty easy to do that because in order to push it up to 103, you only need to eat up, all of these orders. It's not a lot of orders. It's like 90 or something. But if you want to move the market when it's deeper, like for example up here, you can see it's much harder. You need more money in order to move the market. And once again, the same thing is true, but the opposite on the buy side. So for example, this right here is a shallow market, while this part all the way down here, I hope you can see, is much deeper. And yeah, guys, this is all you need to know, at least for now, about order books and depth of markets. Let's continue the course. But right, so now we need to switch the attention here and take a look at a pretty big problem with real-time order flow. And that is that we are seeing tons of manipulation in the market. So the order book looks pretty clear, but one thing that you really need to learn is that not all orders are real or honest. And there are many different types of orders and different types of manipulation tricks that you really need to learn about. So make sure to pay attention now. Let's begin here by taking a look at some common manipulation tricks. And the first trick you need to know about is something called spoofing. This is actually a pretty simple trick. And this is where traders place large fake orders to trick others, and then they cancel the orders before they get filled. So I want you to have the order book you learned about earlier in the course in mind. What traders can do is that they can place massive amounts of limit orders in the book to maybe give a sense that, this is actually a deep market. Or they can even give a sense that, there are so many sellers right here. There are so large, let's say that they place very large sell limit orders. This can actually scare away, for example, small traders like me and you, because we think the market is, it's so deep on the sell side, which can make us sell. That is just an example, but spoofing is a real thing. You place fake buy and sell limit orders in order to affect the price. Another, order type you really need to know about is something called iceberg orders. And what is this? Well, an iceberg order is a big hidden orders that only show a small part. And this is something that many trader platforms actually have built in. And this is, you can place an order in the order book. So let's say that you want to buy a total of 100. But instead of placing the 100 in the order book, you can create an order that plays 10 at a time. So you place 10. When the 10 gets eaten up, you will immediately place 10 more. And when this 10 gets eaten up, you will immediately place 10 more. And when this gets eaten up, immediately 10 more, and so on and so on. This is how iceberg orders work. When that part gets filled, a new part appears, and this is basically hiding the true size of the order. So this is also a way of sort of manipulating the market. The last thing I want to talk about right now is something called layering. And layering is placing fake orders at several levels to create the illusion of demand and supply. So layering is basically, it can be either spoofing, or it can even be things like, combining spoofing and iceberg orders. There are many different ways to manipulate the order book, and this is a big problem for traders like me and you. But don't worry, I will have the solution very soon later on in this course. Yet another problem with the order book and live order book trading is that not every trade has a directional goal. Different traders have different motivations and goals. And what do I mean by this? Well, first of all, speculators and this is basically normal traders like me and you, we of course care about the trading direction. When we buy, we really want the price to go up, because if it goes up, we make that's how we make our money. Or if we short, we really want the price to go down, because that is how we make our money. But there are some trader types that don't care, if the price goes up and down. There's one trading type called arbitrage trading, and this is basically, in very simple terms, when you buy one market and sell another, and they don't really care about the direction. This is a simplification, but don't worry, if you want to learn more about arbitrage trading, I do have a video about that. I will make sure to link it in the video card as well as the description below, so you can check that video out after this course if you want to. Another type that don't really care about how the market moves is something called hedgers, and they basically use a market, one market, to protect another market. And by doing that, they don't really use it to predict the price, so they also don't really care about the direction. So we as traders have to be careful. It's very easy to look at an order book and think that every single order in this order book have a motivation. Every single order is trying to move the price, and this is not true, because there are some traders like arbitrage traders, like hedgers, that actually don't care about the price movement. This is very important to have in mind. Another thing that we need to consider is that not all volume is visible. This is once again almost like manipulation, or it's like a way to not affect the market. We have something called OTC, over-the-counter trades, that basically happens in private. So these kind of trades never show, traces in live order books or even in the market. They often get reported afterwards, but in live order books, they don't even show up. Another similar thing is something called dark pools. And this is when, large investors, smart money, institutions, not small retail traders like me and you, this is where they trade in secret until they reach a good deal. And this is also, at least, in the live market, this is also often completely outside the information of us retail traders. But overall, what you need to learn from all of this is that real-time order books can often give a misleading picture. But now the question, of course, becomes, if this can be misleading, what can we as traders do to get a more accurate picture of the order flow? Alright, so now it's finally time to take a look at our first order flow trading tool. And the first tool we're going to talk about is called Footprint Charts, or in other words, volume footprint. And this right here is a super useful tool. You can use it to, first of all, you can use it to find out what actually happened inside a candlestick, and as a result take better trading decisions. But you can also use the volume footprint to find market structure, like for example support and resistance levels. But here, footprint chart is basically a chart that shows how much buying and selling that happened inside each candle. And don't worry, I will very soon show you this visually, and that usually makes it much more easy to learn. But in simple terms, each price level has two numbers. So each price level inside the candle has two numbers. We have a left side, which is red, which shows the sell volume. And it's very important to notice that this sell volume is market orders. They are orders that are taking liquidity from the book, while the right side is the green side, that is buy volume, or in other words, it's market orders. So we're on the green side, we are taking we're taking from the sell limit side. If this sounds complicated, don't worry, it will be super clear soon. And here are some of the most important terms and features you need to know about when it comes to the volume footprint. The first concept you need to know about is something called delta. And delta is, in very simple terms, the difference between the buy and sell volume. So if we have a positive delta, we have more buy volume than sell volume, which means that buyers are in control. And if the delta is negative, it basically means that the sellers are in control. The next concept here is the point of control, and you already know about this concept if you didn't skip over any part of the course. The point of control is simply the price inside the candle where the most trades happen. And this is very important to learn about, because we can actually use the point of control to find, for example, support and resistance levels. I will show you how to do that step by step. But here we also have the value area, and this one you also know about. This is the area, but in this case inside the candle, where about 70% of the candle's total volume got traded. But here we're starting to get into some more new concept. The first concept you need to know about is something called imbalances. And an imbalance when it comes to volume footprint is when one side trades 3 times or more than the other side. So for example, if the buying side buys 3 times or more, for 3 times or more volume compared to the selling side, then we have a buy imbalance. And the opposite is true. If we have 3 times or more sellers, then we have a sell imbalance. This sounds complicated now, but once again it will get cleared. And here, stacked imbalances is basically when we have multiple imbalances on top of each other. But now let's take a look at how a volume footprint candle actually look like. Alright guys, so now it's finally time to take a look at the volume footprint. And this right here is one of the most important tools we will cover in this course, so make sure to really pay attention now. The volume footprint is basically like having an X-ray on the candlesticks. Before watching this course, you might have only been trading, looking at candlesticks, but what the volume footprint allows us is to see what actually goes on inside the candlesticks themselves. And this might look, super complicated in the beginning, but I will try to break this down in super simple terms, step by step. So first of all, the first thing we need to learn is that we have a buy side, which is the green side, and we have a sell side, which is the red side. And what these sides basically tell us is how much buying volume on the green side and how much selling volume on the red side happened at all of these specific points inside the candle. So all of these specific price points inside the candle. So if we just look at a random price level, let's for example take a look at the one at the top. You can see that it says 0 on the buy side. I hope you can see it says 0 right here, but on the sell side it says 32. That means that we saw 32 of sell volume up here on the candle, while we saw 0 buy volume. And now you might think, you might be confused and think that, for every time someone sells, someone has to buy, right? And yes, you are completely true. But what this volume, what the numbers here tell us is not the sort of total volume. What this tells us is the market orders. Because remember, market orders is when you take liquidity from the book. So in this particular case, we saw sellers, taking liquidity from the buy side. This is what pushes the price down, while we saw no buyers taking liquidity from the sell side. It's very important that you notice that the buy volume is buy market orders and the sell volume is sell market orders. The volume footprint tells us all about who is controlling the price, who is pushing the price up or down. And you do that with market orders, not limit orders. Remember, limit orders are placed in the book. But now, when you know this, you now know that volume footprint is all about who is pushing the price up or down. Is it buyers or sellers? And now, there are a few important concepts you need to learn. The first one is called delta. And we already talked about delta. That is basically the difference between the buy side and sell side. So for example, if we take a look at the delta here at the lowest part, you see right here, we have 14 on the sell side and we have 8 on the buy side. So this right here is actually a -6 in delta. Or in other words, we have 6 sell volume in delta. But what you can see down here, you can see that we actually have a total delta. And that is, if we add up the deltas of all of these blocks, we get the total amount of delta during the whole candle. And in this case, you can see that we had 1.4 thousand bullish delta, which means that the buyers were actually in control over this candle. The next concept you need to learn about is the point of control, or POC. And remember, this was the level where the most volume got traded. And in TradingView, you can see super clearly where the point of control is, because the point of control will be marked with this black bar right here. So in this case, the point of control was right here. And the point of control is very important because we can use it, for example, for support and resistance levels, and it can give many other hints as well. Now, the next concept we need to learn about is the value area. And remember here, the value area is where around 70% of the volume got traded. And when you look at volume footprints, you will see two markers. You can see it says value area high right here, or for short VAH, and it says value area low here, or for short VAL. And it is between these two lines, so this area right here, which is the value area, or for short VA. As once again, I can repeat it, that this was the area where around 70% of volume got traded. And it's very common that the value area is often, relatively small compared to the candle. You can see, for example, in this case, 70% of all volume within this candle actually got traded on the upper side. And that can give a signal that this candle is maybe more bullish than if 70% got traded down here. Okay, so now it's time to take a look at imbalances. This right here is very important. And this is when one side, so either the buying side or the selling side, traded at least 3 times as much as the other side. So, for example, the imbalances you can see by this little dot you have right there. You can see you have a little dot right there, you have a little dot right there, you have a little dot on all of these 3 right here as well. But one thing you can notice is that if you compare, you see it says 304 here, and here it says 118. And you might think, 118 times 3 is actually more than 304. So how is this an imbalance? Well, the trick here is that you actually need to compare it diagonally. So you need to compare it like this. You can see 304 is more than 3 times as large as 87. And that is because the buy side will always be one step above the sell side. This is a bit hard to understand, but you will start to see a pattern. You can see here we have an imbalance because 141 is more than 3 times larger than 21. Once again, here we have another imbalance because 45 is of course more than 3 times as large as 0. Once again, here we have a diagonal imbalance because 45 is more than 3 times as large as 14. And the reason we don't have an imbalance in the next one, we don't have an imbalance because 104 is even larger than 88. You always need to compare the imbalances diagonally upwards when you do it from the buy imbalances, but the sell imbalances is the opposite. And here you can notice the same with the sell imbalances. Right here we have a sell imbalance, and right here we have a sell imbalance. Why? Because 87 is more than 3 times as large as 0, and 543 is more than 3 times as large compared to 157. So I hope this makes sense. And you might wonder, how can we use this buy and sell imbalances? Well, I will very soon show you a concept that is known as absorption and initiation. A little bit hard for me to pronounce, but these concepts can be super helpful in understanding the strength of each candle separately. But before that, I want to take a look at how we can use volume footprint as support and resistance and in our trading strategy. Alright, so now let's jump back into TradingView right here. I am currently looking at the daily time frame of Bitcoin, but you can use volume footprint charts in crypto. You can also use it for stocks. You can also use it for Forex, but it's a little bit, the data in Forex is a little bit more unclear, so volume footprint might work a little bit better in stocks and crypto, but it does work in Forex as well. And here, as you can see, I'm looking on Bitcoin right now, and just like as a side note, we saw a big sell-off in crypto yesterday. But one very cool thing you will notice is that Bitcoin actually bounced where we saw something significant happening on the volume footprint, and I will show you guys that very soon. But first, let's of course take a look at how do we open up the volume footprint in TradingView. Well, to do this, you want to go up here to where it says candles, and then you want to go down right here to where it says volume footprint. And right now, I'm not 100% sure if volume footprint is available for free in TradingView. If you have a free account, please check and let me know down in the comments. But if it's not available, don't worry, because I do have a special link to TradingView. You can use that link to try out TradingView Premium completely for free for 30 days. And if you like it enough, I'm pretty sure you will, or at least I do, but then you will get a $15 bonus if you want to continue on your trading plan. But to open the volume footprint, you simply click right here. And just like that, the candlesticks are transformed into a volume footprint. And now you already know how to read these footprints, or here, your footprints might actually look a little bit different to mine, and that is because I do have another setting right now. So what you want to do if your candlesticks looks like this is that you go to the settings tab, and right now you can see that I have type delta. I think the standard type is to show both the buy and sell side. So let's choose buy and sell right there, and then press OK. So your chart should look like this. You should see, both the buy side and the sell side, just as I showed you recently. And when you zoom in here, you can clearly see, how aggressive was the sellers, how aggressive was the buyers. You also have the delta explained right there. So was the sellers in control during the candle, or for example, like right here, was the buyers in control? But now for this trading strategy, I want to show you one way you can use volume footprint to find support and resistance. And this is a very simple trading strategy, super easy. And what you want to look out for here is that you want to look out for clusters of point of control. This is super easy to spot. For example, right here on the chart, you can see that we have multiple black bars happening at the same time. And remember that the black bars are the levels within the candles where the most volume got traded. And these levels where we have lots and lots of volume traded can often act as magnets in the future. So what we can actually do here is that we can draw a support area. What I usually like to use is go to geometric shapes and use my rectangle. And then you can see we can draw this support area out right here, and you can see if we drag the support area out, you can actually see that this was exactly where Bitcoin bounced before we saw this beautiful move to the upside. And if we even look at the candle that happened just yesterday, you can see that we did see a beautiful bounce at this area. After you have done your analysis on the volume footprint, it can often be helpful to go back to the candlestick charts and see how the price react. And you can see that in this case, the price beautifully bounced right here. We saw a massive move towards the upside, and the price also bounced at this key support just yesterday. And if you're looking for a super simple trading strategy from this support level, it could have looked something like this. You use your long position, so you're looking to make money from the price going up, and then you see the price coming down to the support, and you might enter at the first strong reaction from the support level, setting your stop loss just below the low right here, and with a risk to reward ratio, your trade would have looked something like this, and you would have locked in some very nice profit. But now you might ask yourself, is this, analysis, it seems super easy. Is it enough to only have sort of one bullish sign, which in this case is support, and then take your trade? Well, not really, because in order to make the trades more likely to succeed, we preferably want to combine it with other technical signals as well. And this leads us to the next thing we're going to talk about in this video, which is absorption and initiation. Alright, so now let's switch attention and take a look at two super powerful concepts when it comes to order flow trading. And this right here is absorption and initiation. These concepts can seem a little bit complicated when you first hear about them, but I will try to break them down and simplify them as much as possible. And in very simple terms, absorption and initiation are simply concepts that help you see who is winning the battle between buyers and sellers within a certain candle. And here, first of all, we have absorption. And this is when the price moves in opposite direction of the imbalance. And this right here is a sign of a potential reversal. So I want you to you can write this down in your notebook, that absorption means reversal or weakness. Then we have initiation. This is when the price moves in the same direction or with the imbalance. And this right here is a sign of continuation and strength. So absorption, weakness, initiation, strength. Make sure to write this down. And from this, we can actually have 4 total scenarios. First of all, we have bullish absorption. And this is where we see selling imbalance up here. So we see selling here. But then the price goes up and closes higher. And this means that the buyers absorb the selling, and this is a sort of bullish reversal. Then we also have bullish initiation. This is when buying imbalances appear and the price pushes in the same direction, which means that buyers are attacking. So this is strength or continuation. And then we have the opposite. We have bearish absorption, and don't worry, I know this probably sounds like super complicated right now, but I will soon show you a visual and it will be so much more clear. But bearish absorption is the opposite. We're seeing buying imbalances up here, but prices close lower. This means that sellers absorb the buying And last but not least, we have bearish initiation. This is when selling imbalances and the price go in the same direction, which means that the sellers are attacking. All right, so let's begin here by taking a look at the absorption. And remember here, when we talk about absorption, we are talking about weakness. And one thing that might sound a little bit counterintuitive here is that the red one is actually the bullish absorption and the green one is the bearish absorption. And I'm sorry if the drawing here is a little bit ugly, but what I'm trying to show here is that the green dots right here and right here and right here are basically buying imbalances, while the green dots, for example, right here and right here are selling imbalances. And let's start here by looking at the red candle. The reason this one is bullish, absorption, is because even though we saw selling imbalances right here, so we saw lots of selling coming in right here, we also saw lots of selling coming in down there, even though we saw selling, the buyers managed to push the price up, and we actually, the bears lost control and the bulls managed to close the price above above and despite all of this selling pressure. So as you can see, this candle looks a little bit, if you have been studying candlestick patterns, it looks a little bit like a hammer candlestick. And what you will notice if you study hammer candles is that many times they will have this bullish absorption happening. So this is basically that sellers try to push the price down, but they fail. The selling pressure gets absorbed and pushed up. That is why this is a bullish sign. But now if we take a look at the bearish one, which is often a green candle, this is the opposite. You can see in this case, the seller, was super aggressive. They pushed the price higher. They took a lot of liquidity from the order book. But even though they took a lot of liquidity, the bears before the candle closed managed to push the price down, and we actually closed all the way down here. So I hope you're understanding why why the red candle in this case is bullish and the green candle in this case is bearish. It will be important to have in mind throughout the rest of the course. Okay, so the next concept we're going to talk about is the initiation, and in my opinion this one is often easier to understand, because in this case the bullish initiation is the green candle, bullish tend to be green, and the bearish is a red candle. And this is very similar to the absorption we recently talked about, but in this case you can see that the imbalances and the direction goes in the same way. So for example, if we in this case start with the bullish initiation, so the bullish initiation, you can see that we have buying imbalance right here, we have buying imbalance right here, we have buying imbalance right here. But what you also can see is that the price goes in the same direction as the imbalances. What is very important to notice here is that when it comes to bullish initiation, we want the candle to close here. You see the candle closes right there. We want it to close above the imbalances. Because what story does this tell us about the price? Well, it tells us that the imbalances tells us that lots of aggressive buyers took liquidity from the book and tried to push the price higher. And what the candle close tells us is that the aggressive buyer succeeded with doing this. So the aggressive buyer succeeded, which is a very bullish sign. The opposite is true for the bearish initiation. So here we have selling imbalance right here. We have a selling imbalance right here. The aggressive sellers tried to push the price down by taking liquidity from the book. And by looking at the candle close, we can notice that the aggressive sellers indeed succeeded with pushing the price down. And now it starts to get super interesting, because we can use initiation and absorption together with, for example, let's say that we have a support area or maybe even a demand area right here. We might see, let's say we have a trend that comes down like this, and then we might see some bullish, let's say we see some bullish absorption coming in right here. So we have on the On the sell side, we had some selling imbalances, but the buyers managed to push the price up. And then after this absorption, we might see some initiation, right? We might see a bullish green candle that looks something like this, that managed to see buying imbalances and close the price higher. When we're using initiation and absorption together with, for example, support and resistance, the trade gets stronger and more likely to succeed. And as a result, we are more likely to make money. So if we now jump back into TradingView, we can try to analyze the trade we looked at earlier a little bit more in depth. So once again, we want to open up the volume footprint chart. I can once again remind you about my link in the description and the pinned comment that you can use if you have no access to the volume footprint. But we open up the volume footprint here, and let's see if we can find any sort of absorption or initiation. Well, if we look at, first of all, you remember the support area comes from all of these point of control, so it's good to have that in mind. But what you can notice is that we didn't really see any absorption right here, but what you can see is that on this green candle right here, what did we have? Well, we had a buying imbalance right here, which means that we saw, aggressive buyers trying to push the price up. And we can also see that the price indeed closed above the imbalance. So this right here is initiation. That is a bullish signal. You can also see from the next green candle right here that we saw, I hope you can see, it's a bit hard to see, but we had one imbalance right here and two imbalances in a row. And once again, the candle closed above, so we had yet another initiation candle. So here we can once again, to make the chart a little bit more clearer, we can go back here to the candles, and because we had initiation on this green candle, right, it makes our, that is yet another bullish variable, and that is an argument for taking this trade. But now you might of course wonder, is volume, you might already think, volume footprint seems like an amazing tool, but you might think, is this the only tool we can use, or can we use even more tool to become even better at order flow trading? And the answer is yes. So let me show you guys the next tool. Alright, so now it's time to take a look at our next tool. This right here is a super powerful tool, but it can be a little bit hard to use, and it can also be hard to actually find the right tool in TradingView and to set it up. But don't worry, I will go over everything in a step-by-step manner. But first of all, this tool right here is called the Cumulative Volume Delta, or for short, CVD. And by this point, you already know what volume delta is. It's the difference between the buying volume and selling volume. But here on the name, you can hear cumulative. That is basically that we add up the volume delta, or the volume difference, over time. So you can pretty much hear on the name that the CVD measures the total net buying or selling over time. So it basically adds up the volume delta of every candle to show if, aggressive buyers or aggressive sellers are in control of the market. And here the interesting signals start to come when we compare the cumulative volume delta to the price. So because when we do that, we can start to see, who is actually in control of the market. So for example, if the price goes up and we're also seeing the cumulative volume delta go up, we're seeing that the aggressive buyers are succeeding in pushing the price higher, right? So we often have a strong, healthy move. And here, what you can specifically look out for is divergences between the CVD and the price. So two of the most common divergences, don't worry, I will show you every divergence you can look out for, very simple terms, but you can look out for buying exhaustion, and that is when the price prints higher highs and the CVD prints lower highs. You can also think about this as, you know, bearish divergence that you, for example, see in momentum indicators like the MACD. And by the way, I do have a full like 1 hour long course on the MACD if you want to dive deeper, you know, into you know, indicators that are based on the price action later on. I will make sure to link that video in the video card and description. But we also have selling exhaustion. This is basically the bullish divergence when we see the price printing lower lows while the CVD making higher lows. And both of these divergence types is great for spotting potential reversals or even some hidden absorption. All right, so here I basically have made a cheat sheet of all the different CVD divergences you can find, and don't worry, I will go over all of these step by step, but if you want to get access to this image and all of the images from this today's presentation, I actually release all the presentations to our YouTube community, our YouTube channel members right here on YouTube. If you want to become a channel member, you can do that by clicking join down below. And as I said, all gold and diamond members get access to presentations like this one, but also more things like, you know, exclusive videos, priority replies, you get some emojis, some badges, and at the same time you support the channel. So if you like this kind of content and want to support the channel, consider becoming a channel member by clicking join down below. But now let's go over the divergences. So first of all, you have the orange side right here, that is the price. And you have the blue side, which is the CVD indicator. And when the price prints higher highs, like we're seeing right here, you can see one high and higher high. Let me actually change the color here so you can see clearly. And when the CVD at the same time prints lower highs, then we have a bearish divergence, and that is a signal indicating a potential reversal to the downside. But also we have something called hidden divergence. This is harder to spot and a little bit harder to understand, but that is when we already have a downtrend. So we already have lower highs on the price, but the CVD prints higher highs. This is actually a bearish signal, but it's a bearish continuation signal. So it's a little bit different. But in this video, we are going to focus on the normal bearish divergence and bullish divergence, but I just want to include the hidden divergences as well, because you can definitely use them and they can be super valuable. But now the normal bullish divergence is when the price prints lower highs. So you can see lower lows, one low and then a lower low, while the indicator prints higher lows, one low and then a higher low. So lower lows on the price, higher lows on the CVD. That is a bullish divergence indicating a reversal to the upside. Last, but definitely not least, we have the hidden bullish divergence. This is a continuation signal because the price is already printing higher lows, but then we see the CVD printing lower lows, and this indicates a continuation to the upside. But now I want to take a look at how we can use the CVD, and more importantly, how to find, you know, the best CVD in TradingView. All right, so now let's once again jump into TradingView and let's continue using the Bitcoin chart, because in some other courses, you guys, you know, always wonder, you know, how can we really apply this to all markets and so on and so on. So to keep it consistent, I will try to use the same chart here and just use Bitcoin. But now, how do we open up the CVD indicator? Well, to do that, we want to go to the Indicators tab in TradingView. So you press right here, and you want to search for CVD. And then you can see here, first of all, you can see that we have a built-in indicator that is called cumulative volume delta. Some traders use that one, but that is not really the favorite indicator for me. What I like is one called cumulative, I think it's called cumulative delta volume, like this. And it's this one right here, created by Lonesome the Wolf, I think is called. You can see it should say around 8.8 thousand as I'm recording this video. So you press this one right here, and just like that, the indicator should appear here at the bottom of the screen. But now, in order to make this indicator better, at least in my opinion, and easier to read, I want to change a few settings. So what we do is that we go down here to where it says settings, and then I actually want to change the inputs here, and instead of using candles, I prefer to use a line. So I will change this one to a line right here, and then so you guys can see it more clearly, I'm gonna make it a bit more thicker like that. And for now, I think we're ready to go down here and press OK. But now remember what we're looking out for. We're looking out for when the price prints, when the price and CVD goes in the opposite direction. So for example, if we look at this low and this low, you can see that the price clearly prints lower lows. But in this case, the CVD goes in the same direction. So here we actually had no divergence. So that is, one sign that wasn't bullish about that particular low. But we still, this was where we created the support, and this was where we saw the next bounce. But here, if we look a bit earlier, you can actually see a super clear divergence. You can see right here, we had, one high right here, and then we printed a higher high, so the price prints higher highs. But if you look down to the CVD, you can see that the CVD creates a super clear lower high. And remember, when we have higher highs on the price, lower highs on the indicators, this right here is a bearish divergence indicating a reversal to the downside. And after this divergence up here, we indeed saw a reversal. Let's actually scroll back even more, see if we can find any other kind of divergences. Let's zoom in a bit on the CVD. Well, right here, you can see an example of the opposite. We have one low, then a lower low on the price prints lower lows. But if you look closely at the CVD, you can see that the CVD prints one low and then a higher low. This right here is a bullish divergence indicating a reversal to the upside. And after this divergence, we saw a beautiful move up. All right, so the next order flow trading tool you need to know about is the volume profile. And the volume profile is actually pretty similar to the volume footprint, but you actually have a little bit more flexibility when it comes to the volume profiles. And you will understand why very soon. But first of all, what is the volume profile? Well, the volume profile shows you how much volume that got traded at each price across a range of candles. So instead of just zooming in with an X-ray on one candle, the volume profile can make you look at multiple candles at the same time and assess the volume at each price level. So it's basically like turning your chart sideways to see where the most trading occur. And what you will realize here is that many of the key concepts for the volume profile are the same as the concepts for the volume footprint. So for example, when it comes to the volume profile, we also have the POC, which is the point of control. And you already know that this is the price level where, the highest volume got traded. Or in other words, the market's fair value. Then we have the value area. This is the area where about 70% of the total volume got traded. But here are two new terms. We have something called a high volume node and a low volume node. And these terms are very simple. High volume nodes are tall bars. And I will show you this exactly when we take a look at the visual, but they are basically tall bars on the profile, which represents lots of volume traded, and low volume nodes are short bars on the profile, which are levels with very little volume. And two key things to have in mind is that the high volume nodes are known as areas of acceptance, and they can actually often act as magnets because, a lot of volume have been traded there in the past. It's likely that many market participants will accept these levels and trade them in the future. So many times they can act as magnets and kind of become support and resistance levels. They are not strict support and resistance. It is important that you should not look at high volume nodes as, clear support and resistance levels, but they can definitely be useful. And I will talk about that later. But the opposite is true here for low volume nodes. Low volume nodes is known as areas of rejection. And this is, the price tends to move through these low volume nodes very quickly. So you can use this, for example, to improve your breakout trades, or just to find areas on the chart where the price is more likely to move in a quick and low liquidity manner. Alright, so right here you can see an example of a volume profile indicator. And as you can see, compared to the normal volume, where the volume bars are down here, the volume profile is actually right here on the side. And the first thing you need to know about the volume profile is that the height of the bars represents the amount of volume. So when we have short bars, like right here, and right here, that means that little trading volume and little trading activity appeared at that level. While when we have, tall bars, like for example, right here and right here and right here, it means that lots of trading occurred at that level. And if you look at the black price line, you can see that I have tried to show that in this area, you can indeed see that the price spent a lot of time within this area. So the price had, more opportunity to get volume traded in this area. But what you also have to notice is that it's not only how long that the price spends within this area that matters. What actually matters is how much volume got traded inside the candles of this area. So you could, for example, imagine, an area where the price goes up quickly, but tons and tons of volume got traded. But now let's take a look at the key terms you need to know about. And the first term is the point of control. And the point of control, as you probably know by now, is actually this bar right here. So this is the POC, which stands for point of control. And that is simply the tallest bar. It is the area where the most volume got traded, and this is an area where it's likely to often act as a magnet, so have that in mind. The next concept you need to know about is the value area, and the value area is this yellow area right here, and this is the area where 70% of the volume got traded. So these yellow bars represent 70% of the volume. So this area is like a broader and a little bit less significant point of control, but the same principle applies. The price tend to move more slowly through this area compared to how fast the price tend to move during the areas with less volume. Two more concepts you need to know about is the high volume node and the low volume node. And this right here is an example of a high volume node, or for short HVN, and this simply means a tall bar, a bar with lots of volume. While, for example, this bar right here is a low volume node, or for short LVN, and this is a bar with little volume. And as I have mentioned multiple times, the high volume nodes, the price tend to move more slowly, and the low volume through the low volume nodes, the price tend to move more quickly. But right, so now let's jump back here into TradingView. We are still looking here at Bitcoin, and we're currently looking at a volume footprint chart. But to make the chart a little bit more clear for now, I'm just going to switch to normal candles for a while. And now we're ready to open up our volume profile indicator. And to do this, you want to once again go up here to the indicators tab in TradingView, and you want to simply search for volume profile. And here, as you can see, we as usual, we have many built-in volume profile indicators. The difference between these indicators is mostly, where on the chart should we put our volume profile. You also have multiple built-in indicators, and I do think these pre-built indicators, I do think they are available on the free plan, or maybe you need an essential plan. But if you need a paid plan, as you probably know, if you have been watching this full course, I do have a special link. It will be both in the pinned comment and the top of the description. And you can use that link to get try out TradingView Premium or any other TradingView version for free for 30 days. So if you can't open up this indicator, make sure to use the link. But here, you have, for example, the visible range volume profile. This one will give you a volume profile for the chart you're currently looking at. So when you zoom in and zoom out, the volume profile will change. But if you want more control, you can use this fixed range volume profile. And when you click on this one, you will notice that nothing will happen. And that's because you need to decide the range of the indicator. Let me see here. So you click on fixed range volume profile, and then you need to press on one point on the chart like I did right here. Then you will see two dots will appear on the chart. And this is where you can choose, from what time period do you want to display the volume profile. So here, what I want to do here is that I want to analyze how the volume looked like during this impulsive move to the upside for Bitcoin, because this was a significant move. So I want to know, where did the volume got traded during this period? Because if we know the volume during this move, you can actually think about it as, having looking at this part of the chart almost like a volume footprint, right? You get, instead of looking at one candle, you get a volume for the whole period. And one interesting thing we can notice right away, remember what the volume profile tell us. When we have areas, for example, right here, you can see that we had no volume. And in these kind of areas, remember what I said, the price tend to move quickly. And what actually happened when the price came to this area, you can see right here, the price indeed sharply moved, through this area. But once the price already moved through, the next time it didn't, move through as fast. So that was one interesting thing we could see about this volume profile. Another super interesting thing is, if you look here at the point of control, which in this indicator is this red line right here. Remember, the POC is simply the tallest bar, and you can see the tallest bar is right here. But you can see that this point of control, if we draw a support line right here, you can actually see that this was where we found support earlier in the course, right? This was the level where, the price bounced the first time. And remember, this was the level where we found support from our volume footprint. So that is super interesting that we have the point of control at the same level. And yet another thing, we can see that Bitcoin, as I talked about earlier, we recently saw a massive crash in Bitcoin. And what you can notice here is that the price actually bounced at this level. So I think this demonstrates very clearly how the volume profile can give you both hints about when the price is about to move fast, and we can also get hints about, where is the price likely to, act as a magnet. And in this case, it worked out beautifully. We saw 3 bounces right here on the volume profile. But okay, so now you know about the volume profile, you know about the volume footprint, you know about the cumulative volume delta. I would say that you now know more than 99% of traders when it comes to order flow trading. So congratulations if you made it this far in the course. If you have liked the course so far, make sure to drop a like. You can also drop a comment. It really helps out with the YouTube algorithm and all that. But last but not least, before we wrap up here, I just want to give a quick summary of how to use the tools together. So remember here, the volume profile shows where on the chart, where on the price levels, the battle between the bulls and bears appeared. We can see on this level, there were, lots and long battles on the chart. And in this level, pretty much nothing happened, which means that the price can move quickly through that level. The footprint chart is when we give an X-ray to the candles. We can see how the battle played out inside the candles. The footprint is super, super important. If you still find the footprint hard, I highly recommend to go through that part once again, because the volume footprint will build upon all of the previous, in order to understand the next chapters, like the cumulative volume delta, you need to have a basic understanding of the footprint. So don't be, shy to rewatch the whole course to really lock everything in. But the CVD shows who was winning the battle over time. Remember, the CVD, we're adding up the deltas over time. And you can combine these tools in multiple different ways to improve your trading and as a result make more money. So you can, for example, use profiles to find, what zones that are worth watching. You can use footprints to both look for absorption and initiation, and you can also use it to find better support and resistance levels, and you can use the CVD to find divergences and to sort of see the overall bigger picture, who is winning the long-term battle. And as a general rule of thumb, when price and delta agree, the move is stronger. When they diverge, it's weaker. And here, and this is super key, you now, as I said, you know more about order flow than pretty much everyone. But in my personal opinion, you really want to combine order flow with market structure and price action. Alright guys, so this course is coming to an end, and if you made it all the way through this course, I'm actually super impressed. If you want to, you can write down the code word full course down in the comment section just to prove that you watched the whole course. Nowadays when we have TikTok, Instagram Reels, and the attention spans are so short, sitting through a 6-hour course is actually quite impressive, and I really hope that you learned a ton from this course. And yeah, if you did enjoy this course, the most simple way to help out the channel is to just drop a like and of course subscribe if you want to. Yes, this was a super long course, but even though you watched 6 hours, you are actually just scratching the surface. There are so much more to learn about trading, so make sure to subscribe so you won't miss any of the more advanced lessons here on the channel in the future. And also guys, if you want to take it to, the next level and support the channel even further, I do have a membership community right here on YouTube. This is only, if you really want to support the channel and if you want to get some bonus material. For example, all of the presentations in this course are available for members, gold or higher. And I also have multiple, exclusive guides. I have some trading tools and some other good stuff as well. So if you want to support the channel and get some extra stuff, make sure to click join down below to join our YouTube community. And last but not least guys, this is only the beginning of your trading journey. So when you have the time, I highly recommend to check out this playlist right here. Here you can find all of my free trading courses right here on YouTube. I hope I will see you in another trading course very soon, but for now, take care. Ciao, ciao.